Okay, well, welcome everyone to our regular Mello Monday, back after 3 weeks absence. I think most of you have probably been watching the football and maybe the tennis as well. I have to say, a lot of people seem very deflated this morning, but I don't think we really need to. There are so many countries that didn't make it to the final. I think we should all be positive that we've got a good young team that hopefully will see us in the football through to the next few years. Maybe some real trophy success. It's only 15 months before we'll be thinking about the World Cup. And Wimbledon. Now, what about Wimbledon? If ever anyone saw the tennis, I know Djokovic won again, but what about Emma Raducanu? She's a local girl. She plays at my tennis club. So I'm very, very pleased for Emma. She got to the 4th round. She's only 18, and I'm sure we're going to be hearing her name in the future. So when we move away from sport onto business things, and I hope most of you are ready for what will be quite a show tonight. We've got a lot happening. We've got, first of all, CentralNic with us. They are literally coming from the other side of the world. I think Ben's joining us from. So I don't know how Australia, I think probably, is Ben in Australia, Michael? Here's Ben.
Yes.
Yeah, Ben, you're on mute, Ben. Yeah. Great. You're still on mute, Ben, I think.
There we go. Yes, I am.
There you go.
But great to be.
How did Australia take the football?
Well, you know, we're more believers of the different shaped ball.
Oh well. Good. Anyway, CentralNic actually came to one of our physical events, I think, in the past. No?
Only visitors, but we didn't present.
Okay. Well, this is a great opportunity for you. We've already got 200 plus on the webinar, so do tell us all about how it's going at CentralNic.
Fantastic. Thank you very much, David. So, Michael, are you going to present here?
Sure. Let me quickly put it on the screen.
Perfect. So, let me tell you about CentralNic. So basically, we're in the business of providing companies with the tools they need to do business online. The company IPO'd back in 2013. And here, let's just get this page. Fine. So you could describe us as a software as a service and an e-commerce company. And our growth is driven by more and more people getting access to the internet, more and more businesses starting to trade on the internet, and those businesses making more and more money on the internet. We're a completely recurring revenue business. 2 recurring revenue models: subscription model, where people pay every year for the use of a service, and a continuous pay-per-use model, where we have a ongoing contracts with customers, and we continuously do business with them. Our business delivers over 100% cash conversion. So last year that was $30 million, and this year the analysts have forecast $40 million in EBITDA, which will convert to cash. And there's a simple reason for that. We don't give credit to most of our customers. They have to pay us up front, but we do get credit from most of our suppliers. So we hold cash for a long period of time. Our organic growth rate in Q1 and in last year was 16%, and that was very much a deliberate thing. Historically, it was only 6%. If you go back a couple of years, we restructured the business at the beginning of last year, brought all the back office functions into a centralized core, realigned all the businesses, put a lot of new commercial heads in, put new product team, new developers to build the new products, and jumped from 6 to 16%. And because that's not the market changing, that's us structurally changing, that's a fully sustainable growth rate. you'll see there's a lot of upside from new revenue streams. So we are light on some of the products and services that our customers want, things like hosting, building their websites, giving them online brand protection, and so on. So there's plenty of upside that we could get from existing clients. And another great thing about our industry is that there are still many small companies that we could acquire. We've built our business very successfully through acquiring businesses, and we have and there are still plenty more out there of small independent companies that we could buy. So summary is we have diverse revenue streams. We sell a lot of things to the same customers. There's lots of cross-selling opportunities. We're a global business. We've got hundreds of thousands of customers in almost every country in the world, and more than 45 million domain names. So there are only 370 million domain names in the world. 45 million touch one of our platforms. So 12% of all domain names we touch. Next page, thanks, Michael. So, how big is our market? Well, in terms of people selling things online, that's a $4.28 trillion market last year, and it grew at 27%. And that's only e-commerce companies. Obviously, there are a lot of offline companies that still get customers online, so the market is even bigger than that. Now, obviously, that attracts a huge amount of entrepreneurs and new businesses and existing businesses saying, I want some of that. So what are the things they have to do to get it? Firstly, they need to buy a domain name. And this is our original business. Selling domain names is a $5 billion market with relatively low growth, 3% per year on average. But we call that the foundation. Now, the next thing you need to do after getting a domain name, a name for your website, is the website itself, online presence, hosting, SSL certificates. There's a group of products and services there. And that market is about a $25 billion a year market. But the biggest of these markets is traffic, because once a company has its website, it needs to acquire customers to come and buy from them. And that is a $400 billion market last year. It grew at over 20%. And this is what we call online customer acquisition. It's the marketing spend of all these businesses online to attract customers to their websites. So those are the three segments we're in. They don't actually match exactly with our reporting segments, though, just because of history. So our reporting segments are that last part, online marketing or traffic. We report on that, but we combine together domain names and hosting and so on. And instead we report on our direct customers, where we're selling to everyone from small businesses to some of the largest companies in the world, versus our indirect customers, where we supply pretty much all the major retailers in the world that sell domain names. We supply them with some of the domain names and other products that they sell. So those are our three reporting segments: direct and indirect, and then online marketing. Next page, thanks, Michael. So just to drill down into this a little bit, for the domain names and the online presence services, those direct and indirect segments, who buys them? Basically, people buy domain names for email. First of all, you can't run a corporate email unless you have a corporate email address. And then secondly, for business websites. But they're not the only reason people buy domain names. Brands also think about domains as online trademarks. So in the same way as they'd go to their IP lawyers and say, please get us trademarks that match our brands in every country in the world, they'll come to us and say, please get us domain names that match our trademarks in every country in the world. And then lastly, there are domain name investors. It's like the secondary market in domain names. When a company goes out of business, its domain name becomes available. A domain name investor will buy that domain name, hoping to flip it at a profit, but also because there used to be a website there, there's still customers going to that website, and it's possible to monetize that traffic, which means to sell that traffic to other businesses that are trying to buy traffic to get customers to come to them. Key characteristics of domain name industry: recurring revenue, their subscription products, immune to economic downturns. So last year was our best year ever, and not just ours. Many of our suppliers and competitors had their best year ever during the COVID crisis. The renewal rates are very predictable. So all the data about our industry is all published and has been for 20 years. And so you can very much see that basically people who've had domain names for a long time, websites for a long time, will renew them at a very high predictable amount. And then there's entrepreneurs that will buy a lot, have a lot of business ideas, have a lot of domain names, register a lot, and then on the first anniversary drop a lot because they've dropped the idea of, or they picked the right name for that idea. On average, that comes around at 79%. Our growth is hugely resilient. For 20 years, we've been competing against many of the biggest companies in the world. Amazon telling businesses, don't set up your own website, come to Amazon, set up a store here. Facebook saying you don't need your own website, set up a Facebook profile. App developers saying, hey, you don't need a website, just put an app out and people can use it on their phone. And despite those vast amounts of competition from the biggest companies in the world, our business and our industry of companies building their own websites and selling online has grown and grown and grown at very predictable and steady rates. Customer stickiness is a super important thing here. Customers do not switch suppliers in our industry. It costs money, it adds risk, there are technical complications. Less than 2% switch from one supplier to another. We monitor it very closely. Happily, we always win a little bit more than we lose each year, but nobody loses customers here, which means it's a great industry to do acquisitions in, because you can buy a company and you know you will not lose their customers. And there's still many attractive targets out there for us to acquire. Next page. Thanks, Michael. Now onto the online marketing business. Oh, I'm not seeing it. Oh, there we go. Thank you. Yep, it's there. I got it. First of all, we've talked about this massive underlying growth of the online e-commerce business, and so why do people need this online marketing? Well, you can imagine if they're making $4 billion in revenues, they have significant budget, say 10% of that, $400 billion, to go out and win new customers. And they don't just want to win a couple of customers. They want a machine, a methodology to continuously win new customers. And what's a good customer? It's good traffic. It's traffic that delivers you a return on investment. So basically, when you sell a product, you make a profit on that. Now, if it costs you more than that profit to win the customer, you have to spend more than that on online marketing, you're losing money. Ideally, what you want to do is have a target profit after the cost of acquiring the customer. And so you set a target and say, I don't want to spend more than, say, $5 to acquire customers to sell this. So and that's what we do. That's what we deliver to advertisers. So how do we do it? We access tens of millions of websites and domain names with our technology. And in fact, we have exclusivity to 20 million domain names that we're the only people that can sell the traffic, the customers that come to those domain names. So we use artificial intelligence and enormous processing power to churn through all of those and identify the traffic, the potential customers on other websites that would potentially buy the product that our advertisers are trying to sell. And so we use artificial intelligence to analyze the context, which means what the content of the web page that the person's visiting, the domain name itself. If the domain name is called, Brixton Bicycle Shop, then you have a good idea about, or our computers have a good idea about what the person's visiting that site, what they want, and will therefore sell that traffic to someone that's selling bicycles in South London. It's recurring revenues. Basically, it's what we call programmatic advertising, where people they put in the settings and we actually do it for them. We say, look, you measure the ROI, you keep giving us feedback, and as you give us feedback about what the good traffic is versus the bad, we'll get smarter and smarter at searching out that traffic over the internet and bringing it to you. We're also future-proof. We do not use Google search across any of our businesses. It's completely irrelevant to us, which means that Google can change its algorithms all the time and it won't impact on us, or will, but only positively, because for people using search engine marketing, people using search engine optimization, those marketers will lose business and fail, and we will gain business because we're not using Google search at all. We also don't use cookies, which is another technology which a lot of other online marketing companies use, and we don't, and which is great because cookies are about to be banned by Google. They already have been by Apple, and when they were, it didn't impact on our business at all. And lastly, we do not collect private user data. As you may well know, there's a lot of legislation coming about restricting online companies from collecting and using private user data. Happily, we've never used it. So again, that will be to our advantage. Next page. Thanks, Mark. So summary of the strategy: we provide all the services required to get businesses online. This is a recurring revenue, highly cash generative business with diverse revenue streams, cross-sell opportunities. We're building scale rapidly. We have 15% organic growth, and that's because we restructured our business 18 months ago to have that kind of growth. We're expanding our portfolio of new services. We're launching new services. We're partnering with new partners. We're looking at acquiring new services to be a full one-stop shop so that anyone that comes to us to buy a domain name can get the full suite of services from us in future. And we have a long pipeline of potential earnings accretive acquisitions. We're generating a lot of cash now, so we should be able to make a lot of those acquisitions just with cash on hand. Next page. Thanks, Michael. And over to you.
Thank you, Ben. This is all very exciting. And the question that we will now be addressing with you is, how does this all translate into financial success? When we take a long-term perspective, we see that CentralNic has doubled its revenue not in 1 or 2 years, but in 6 out of 7 years since its IPO, leading to a consolidated growth rate of 79%. And on the bottom of this slide, you actually see all the acquisitions that we've done in the meantime to get there. And together with our recurring revenue, we are very comfortable that we will actually meet or beat the $312 million consensus revenue that's currently in the market. If we take a shorter term view, we actually see that Q1 was, without any question, the best quarter ever. Our revenue increased by 48% from $57 million to $84 million. Our net revenue, respectively gross profit, grew by 57% to $28 million, and our adjusted EBITDA for the first time became double-digit in a single quarter. And at the same time, despite having completed 2 acquisitions, our net debt actually diminished to $79 million. Where does this growth come from? When we take the segmental view, and Ben has gone to the segments before, we see that all our segments actually have strong growth. Indirect and direct, the 2 constituents of our domain and online presence business, grew at 24% and 29% respectively. And online marketing, even though helped a bit by M&A, actually grew by a staggering 75%. If you strip out the impact of M&A and other one-off effects, the growth rate actually stands at 13%, the organic growth rate, and for indirect and direct, and at 19% for online marketing. Gross profit grew with it, and despite our investment in more staff to actually augment our growth rates to the levels that we are now seeing, EBITDA is still up from $8.2 million in the first quarter 2020 to more than $10 million in the first quarter this year. We've also, given all the M&A, we've also provided pro forma revenues. So as if the group would have always had the same constituents as it has today, revenue would have been $73.5 million in the first quarter 2020, pretty much the same revenue for this second and third quarter. And the fourth quarter, as one would not expect differently from a company that has a strong marketing angle, was then at almost $80 million. However, we actually managed to beat that figure in the first quarter 2021, which augurs well for the rest of the year. Coming to the balance sheet, on the 31st of March, we presented the strongest balance sheet ever. Equity rose to a record of $120 million at book value, roughly 1.5 times our net debt, and also the cash balance of $43 million was the highest cash balance that the company has ever presented. When exploring where this cash all comes from, we also see that on a cash conversion level, also the first quarter 2021 was a record one, $12.5 million of operating cash flow according to IFRS, more than 10 times the operating cash flow than in the first quarter 2020, and more than half the entire cash flow for the financial year 2020. Having said that, we are doing a lot of M&A. We are also at each financial reporting date adjusting our EBITDA and cash flow for impact by M&A. And here we see that actually our operating cash flow conversion has increased from 46% to 163%, which makes us very comfortable that we will be able to at least match the 115% adjusted cash conversion of 2020 also in this year, 2021. Speaking about acquisitions, so here is basically what we did over the last 12 months. So in November last year, we acquired Codewise, which augmented the suite of services that we offer in our online marketing business. Then early this year, we then acquired Safe Brands, a French corporate domain name registrar and brand protection business that helps us venturing into this market protected by its language barrier. And last but not least, we then acquired in February this year a company called Wando, which provides us with more technology in search engine marketing and display advertising, allowing us to procure traffic directly for our advertising customers on the vast array of third-party websites, which will ultimately help us balance our margins in this business. To sum it all up, the investments in new management staff and systems has actually paid off in the form of accelerated growth. Also, it is all segments that contribute to that growth. So each and every business unit that we are currently operating is growing at double-digit rates. There is still a huge pipeline of value-added services and other products and features that we are going to roll out in our direct and indirect segments. And last but not least, this entire success has happened before the background of the COVID-19 pandemic, which makes us grateful for having at least survived this year in good financial health. Post the quarter, we completed the last outstanding deferred consideration items for 2 acquisitions, Team Internet, a huge success that basically brought us into this online marketing business, and then Safe Brands, which is still a very young deal, but hopefully we will be able to tell the same exciting stories about this deal as we can today do about Team Internet. With that, I pass the ball back to Ben, who wanted to address a few words on ESG.
Yeah. So just to wrap up, or before we wrap up, we wanted to be clear that environmental, social, and governance issues are extremely important to us. We actually made our company carbon neutral back in 2012, but then we acquired 14 more companies that we've had to over the years make all of them carbon neutral as well. And with a small carbon credits payments, we've actually achieved that as of last year, which we announced in our annual report. Happy to say also that we do run a fund where we make grants and donations to worthy causes to do with internet development. So these include all sorts of things, prevention of teen suicide, people who are disabled, helping them use new technologies, technologies to try and identify fake news, and many other projects, which over the years we've actually invested now over $500,000. It's not an investment; they're grants, and so for any investors that is concerned that the companies they invest in are on the right side of all of these issues, we very much are and plan to continue to be. And so then just to wrap up on the last page, thanks, Michael. Summary is we've accelerated our organic growth. Our market consolidation continues, and obviously we expect to be trading in line with market expectations, as you've heard from Michael. There's more accretive earnings accretive acquisitions out there for us to look at. We will be putting out our H1 results at the end of August. There's a few other notes on us out there at the moment. There's Stifel, Berenberg, Investec, Edison, and Zeus are all covering us now. And in about 12 months' time, we'll have the opportunity to renegotiate our debt. Almost all of our debt is a bond in Norway, and we will be able to renegotiate that at lower rates 12 months from now, which is 12 months in advance of when we would need to. So on that note, I will wrap things up, and we'd love to take some questions.
Great. Thank you, Ben, and thank you, Michael. We've got a few questions in already, and just to remind all the audience that you should put your questions in the Q&A box, and I will do my best to ask them for you. And if we don't get all the questions asked, then Ben and Michael hope to be able to get the answers to us and put them on the website. Cool. Okay, so first question. You started the year with your shares trading at £1. You've announced record results twice since then, but your share price has been only in the 80s and does not seem to have increased very much. What do you think is the reason behind that?
Sure. Look, in fact, there's a very simple reason behind that. One institutional investor, the largest institutional investor in the world, bought our stock along with many other small cap UK companies, and at the beginning of this year decided that they wanted to sell it. And so they've been a seller pretty much consistently from back when our shares were £1 in early January, but very happy to say that they've just sold all their shares. So we do expect that continuous downward pressure on the share price that we've experienced pretty much all this year is coming to an end.
That sounds good for new investors then, if the seller's almost out or is out. Great. Now, Mike Ayres asks, lots of great sounding words in the presentation. Your turnover is rising, but does not seem to be profitable. Debt is rising and the margins are very minimal. Why should we invest, he says?
Well, I look, for us, and I'm sure Michael can elaborate on this. We view adjusted EBITDA as the best measure of profit and the most appropriate one for our company, for a few reasons which he can elaborate. But one of the key ones is it almost exactly matches cash generation. And so if cash generation is important to you, then we're very highly cash generative. Michael, did you want to maybe address the items between adjusted EBITDA and reported profit under IFRS?
Right, sure, happy to. So the biggest item that is between our adjusted EBITDA and operating profit is amortization of intangible assets, and this amortization of intangible assets comes exclusively from the acquisitions that we've done, where on each acquisition we need to allocate a certain part of the purchase price paid to specific intangible assets and then amortize them over time. However, other than depreciation on tangible assets, where you would have replacement capital expenditure following up on the depreciation, here this never happens. So this is the systematic non-cash item. Then there is the second largest item is what we call non-core expenses, which are basically one-off expenses, also around the acquisitions. So fees for due diligence, contract drafting, and also refinancing activities, which have nothing to do with the operating business. So this is why we separate them, to give a better or to allow for a better assessment of the operation performance of the business. And last but not least, the third largest item is our share-based expenses as part of the management and staff remuneration system, which are also all share settled and hence do not have any cash flow impact on the company.
Do you want to stop screen sharing now? It's probably helped the audience to see you on screen. That's it. Lovely, lovely. Okay, well, Charles Ford asks, you are issuing equity at quite a high rate, a CAGR of 24%. This might be a concern to investors. Do you have a comment on that?
Well, so we only issue equity for the purpose of acquisitions, and for each acquisition we make sure that the transaction is immediately accretive. Some acquisitions we've issued by debt, which have then not increased the number of shares outstanding, but the acquired earnings are always higher than the interest that we pay on the money borrowed on the deal. And also when we finance transactions by issuing equity, just like we did in last November, we also make sure that the additional profit per share issued is higher than before. So that's one of our key investment criteria, that every acquisition is always immediately cash flow positive and always immediately earnings accretive.
Okay, that's good. Ian Davis wants to know, you only appear to have a 5% free float, or is he missing something?
Well, I'm not entirely sure on what your definition of free float is, but essentially we've got staff and directors holding about 30% of the company at the moment, and so the rest is all held by institutions, which we signed up and sold shares to one at a time over the 7 years since we IPO'd. I guess trading volumes have tended to be a little bit thin because, generally those guys are holders. They're not buyers or sellers. But that's obviously one of the reasons that we're here, is that we really do appreciate a better mix of shareholders, and so there's certainly shares available, and they do change hands.
It maybe worth naming a few of the major shareholders you have.
Yeah, absolutely. So it's BlackRock that just sold their shares, but our main shareholders include Kestrel, Herald, Schroders, Canaccord, Lombard Odier,
Schroders.
Yeah, well, who else? We've got an awful lot.
Yeah, sounds it.
Yeah, Majetti is in there, and so on. Yeah, we've got about 35 institutional shareholders, and then in the bond, we've got a bunch of European institutions as well.
Yeah. Now, Vivek asks, if acquisitions are and have been a key part of your strategy, why do you exclude associated costs? With respect to share-based payments, do you think shareholders care about future dilution? The share count has more than doubled in less than 5 years, whereas free cash flow has not.
Right. So when we say we exclude associated costs, we of course include them in our operating profit in all GAAP figures. We only exclude it in the adjusted EBITDA, which, as we mentioned before, has the purpose of presenting our operational performance, where we believe that M&A costs are not helpful in assessing it. But of course, it's a fair point. At the end of the day, the company also has to pay these expenses. However, when the second part of the question, I think, is not quite accurate. The number of shares has more than doubled. However, 5 years ago, that was in 2015 or 2016, depending on where exactly we look at. In those years, the revenue of the company was smaller than today the cash flow. So the cash flow has clearly grown faster than the number of shares issued.
Yeah, to be clear, it's grown from about 5 million to about 40 million. It's grown very significantly.
Yeah. Great. Now, Peter asks, an interesting presentation. Is the company based in Australia?
No. The company, our engineering hub is in Germany and Poland. So we have a large amount of expert tech engineers in those countries. That makes up the bulk of our staff. Then we have essentially a corporate headquarters in London, and sales operations regionally all over the world, Australia, New Zealand, but also US, Canada, Chile, France, Germany, etc. And even Slovakia, Romania. We love Eastern Europe. They're fast-growing areas. I happen to be visiting my family in Australia, but we're in lockdown.
Okay.
I'm here for the duration.
That explains it. Yeah. And Mark Simpson asks, Stockopedia, which, by the way, a lot of the investors on the show do use, it shows directors continuously selling shares at current levels throughout 2020. Why is this?
It was actually only 2 directors, not all directors. One of them went through divorce, which unfortunately forced him to sell some shares, and And the other director who sold some shares only sold a very small fraction of their total shares, but also he had some other ventures which ran into trouble during the COVID pandemic and had to liquidate a small part of the shares. However, there are also directors who are actually buying shares. Just recently, there was a series of announcement of director dealings actually buying shares, and also Alex Zifrin, who has left the company a year ago, and I myself have invested literally the entirety or near entirety of our sales proceeds of our company KeyDrive into CentralNic shares and still hold all those shares. So there are among the directors quite big fans of our share.
Great. I think that might be all our questions. I haven't got any more in the box unless anybody in the audience has an additional question. That looks like we're pretty much on time. One thing I'd like to ask you maybe before we finish though, it's always good to know if there's anything that you see as a high risk for the company. Is there anything that would keep you awake at night? Obviously, at the minute, you're in a different time zone, but it'd be good,
Yeah,
good to know it'll keep you awake at the minute for the day. But yeah, anything that would worry you?
You know, if we go back a few years, the company used to have a non-recurring revenue business line that contributed half of our EBITDA. And that kept me awake at night, and it troubled other investors and so on too. And so we decided to shut it. We said, all right, it was highly profitable, exactly, contributed half of our profits, but we realized we want to align this company with investor preferences. And if we can, and our industry allows us to be a pure play recurring revenue business. So we figured, look, that, you know, we'd be fools to not take that challenge and opportunity up. And since we've made it into a pure recurring revenue business, there's not much that actually keeps you up at night, because you know that, you know, no matter what, that money's going to just keep rolling in. So I'd say we had issues like that. We've addressed them. We've moved on, and so now we're good.
Good. Well, while you're answering that, another question's come in, so we do have 1 minute to answer it.
Right.
Gordon says, since December 2019, CentralNic's share price has been relatively flat. Do you think the market is awaiting some major news, or they are feeling negative towards CentralNic? And what will take it to increase the share price?
Well, I think, as we mentioned, the share price was popping up to £1 at the beginning of this year. So, because when we started to report our record year last year, and followed by our record quarter in Q1 of this year, I think there's been a lot of upward pressure. But sadly, there's been this big seller that's been holding us down. But I believe we're on the way up already. It's just we've had to overcome this one obstacle of the big seller.
Great. Okay. Well, fingers crossed. You're on an upward trajectory, in fact. And I know that our next guest, who's a fund manager, actually has CentralNic in his portfolio, so he might even be commenting on you as well. You never know. But thank you, both of you, for coming to Mello, and let's see how we go from here. Thank you.
Appreciate it, David. Thanks very much, everyone, for listening.
Thank you. Yes, there's
270
on the webinar at the moment, so that's great. Thank you.
Excellent. Hey, Philip.
How you doing?
Thank you. Okay, great. Well, here is Philip. Welcome, Philip.
Thank you.
Probably interesting for you to hear all the different questions that come in for one of your portfolio companies, by the sounds of it.
Yeah, it is.
How long have you held CentralNic?
For about a year, actually.
Ah, right. Great.
So,
Okay, well, you're new to Mello, and most of the audience, I suspect, will not have seen you present anywhere. I don't know if you did any live presentations to wider investors before, but it's great for us to have you on the show.
Thank you.
And of course, at the moment, we're in a period where we're all a little bit deflated, but I'm sure you'll appreciate that, you know, we like to give Mello audience some happier bits of news. So how's your fund done over the last year? That'll probably give us something to perk up about.
Well, unfortunately, it is the case that we only offer strategies to qualifying professional investors. So we have to be very restricted on what we can say about precise details. But it is something, what we can say is that it's a sector leading return. It's as strong as all the other leading players in the smaller company spectrum.
Yeah. And why did you want to create Raynar Portfolio Management? What was it behind it?
Indeed. Well, yes. So beginning of 2020, I founded Raynar Portfolio Management. So that was a culmination of a lot of work and even longer thinking about whether I would ever get to this point of having my own firm and being at the head of it. And of course, we ended up picking the point just before the pandemic hit. So we're only 18 months old, and the entirety of it really has been during unusual circumstances. But we were able to announce that we exceeded 100 million of AUM in June. So we feel very pleased with hitting that milestone. And if I step back and think about it, I mean, it's something that it is the case that I've always thought when even at my school days, I was thinking, you know, what do I want to achieve? And being a business owner is a very simple thing to think about, but it takes a lot of doing. And I found that out from talking with all these entrepreneurs, all these different companies that I meet with as an investor. And it's very inspiring, of course, to understand how people start off and grow a business. And that is certainly fuels my desire to do the same for my own. And the other key desire is something that I've struggled with a bit over my career is being part of an organization that really does truly put the client interest first. And I do find that as companies get larger, that focus on the customer sometimes takes second precedence to the interests of the firm. And that's not something I expect to happen when I'm running my own firm.
Good. Well, certainly you've got a great track record. Many will have heard of you from your days at River and Mercantile. And I guess some viewers will be interested to know why you would leave a big fund and actually, as you say, create your own smaller fund.
Some investors might be aware that I didn't leave at a moment of my own particular choosing. And I'd love to obviously provide more details and lift the lid on that. But unfortunately, I'm sure your viewers can appreciate that in these situations, firms like to wheel out their expensive lawyers and tie you up in knots. And ultimately, if I've got a piece of advice, is you've got to be very careful who you choose to go into partnership with. So if you ever find yourself looking at potentially joining forces with other partners in a partnership structure, one thing to bear in mind is that you have massively less rights than you would as an employee. So when there is a false accusation made against you, as is the case, of course, I assert was the case in my circumstance, it's a false allegation. There's actually very little you can do, and you have much fewer rights, as I say, than if you're an employee. So ultimately, in reality, other people, senior management, they have very particular motivations. For me, at the time and now, I can see it as a blessing in disguise, as a catalyst to get on and do something that I was already starting to think seriously of doing, setting up my own firm. And in the end, that was accelerated, and here I am. So that is yeah, pretty much the limit of what I can say about those circumstances. And of course, you and I, David, we discussed on a confidential basis.
Yeah.
And I know you have very high standards and of who you invite to present. So I'm very grateful for this opportunity.
Well, all the audience will be pleased to know that we fully checked out as far as we could. We didn't want to embarrass anyone. And you're absolutely right. You do end up tied up by confidentiality. So we appreciate that. But the one good thing I can say definitely on your behalf is that absolutely everyone that I asked in the industry said, no, Philip's a very, very good and successful fund manager. So you're certainly coming with good references. And the other thing that I probably want to clear up really is at the moment, you can't actually, promote anything yourself, unfortunately, because you've not got the available sort of permissions. But I think you plan to in the very near future. So maybe just let the audience know about what the plan is there.
Well, what I would say is that we're fully permissioned to provide fund management services. Only at the moment, we've chosen to do so offshore in a structure that is only available to qualifying professional investors. And if I understand correctly, David, unfortunately, you can't guarantee that there's not retail investors on this call. So that does prevent me from talking about any particular product or fund that Raynar Portfolio Management currently offers. But it is a case that we have had really a very pleasing amount of inbound inquiries. Lots of my former clients inquiring whether I might be able to bring forth a structure that similar to what I've managed in the past. So of course, it would be very remiss of us not to listen to our customers, and that is actually a core founding ethos, is to listen to what our customers really want. So we can't say anything specific, but it's reasonable to expect that we should be thinking about what we can do next and build upon our strong base that we've got so far.
Great. And, you're well known for investing in exactly the type of companies that our audience invest in. The UK smaller companies sector. And you're focusing on that area again, I think, with Raynar. So why do you continue to focus in that area? And is there anything you can tell us about where you see it going?
Sure. I just find as smaller companies a fascinating part of the market to focus on. And we've got long-term data that shows that in the UK market, at least, the smaller the company, the stronger the long-term performance over the very long term. And that's data that the London Business School produced since 1955. And so when I think about smaller companies, I think, why is that relationship so strong and so sustainable? And really the only time that didn't hold true was in the 90s, when large caps outperformed. And you could argue that in the internet bubble, it's basically because a lot of very small sized companies became those internet bubble stocks that were hugely overvalued in most cases at the time. So you've got that long-term relationship. So what is that driving that? It's got to be earnings growth, cash-backed earnings growth. And also, I think it's structurally lower valuations as well. So with that structurally stronger earnings growth, it starts with sales. And I think it's a simple concept, really, that the smaller the company, the greater the potential for growing fast. So if you're starting from a small base, you might only need to add 1 million of sales to grow at a high percentage rate. Whereas a large company might have to add tens of millions, hundreds of millions. And so my focus will always be on those fast growing small size firms. And then if you're growing fast, you've got your economies of scale kicking in. And so your margins start expanding. And that is a very strong accelerant to earnings growth. Large companies, they just don't have that. They often have diseconomies of scale. And I've been in firms where you can see the bureaucracy is expanding faster than the business. That's depressing margin. That's not adding value to shareholders. And you've got M&A as well, which famously destroys value in large caps, but adds a lot of value, I find, in selected situations in smaller companies. And then you've got the discount valuation as well. So, the vast majority of my time, the last 15, 20 years investing in the market, you can identify that the small caps trade on really quite deep discounts to the wider market. And that is despite their faster earnings growth. So exciting area to invest in, and great for a stock picker such as myself, trying to find the cream of the crop in that universe.
Yeah. So give us a feel for how you might come about the companies in the first place. Do you have a small team that helps you? Do you pick up little nuggets of information from smaller investors in the same space, or how do you come about a company in the first place?
We have full access to the research output of the banks and brokers that produce research, and we pay for that all on our P&L. And that means that we've got that full insight into what brokers are talking about. But ultimately, the day job is listening to what companies are saying themselves and reading what they're putting out there, the news statements, the results, the annual reports. That's the fuel for what we do here. And if I think about what I'm looking for, you've got to start from a strong base, a strong foundation. And for a company to create shareholder value and for therefore their shares to be worth more, you really need to start with a strong market position and then build upon that with a strong management team that have created a clever strategy to really exploit that strong market position that the company enjoys. And then you've got those ingredients in play, but sometimes that can be sitting in the pot for quite some time before it comes to the boil, as it were. And at which point, what we find kicks those shares into life is an inflection catalyst. And that could be a macroeconomic catalyst, the upturn in the economy, certainly boosting a lot of companies, but it could be something specific to that sector or to that company launching a new product or service, or a new management coming in and improving the company's situation. Ultimately, what it's all about is finding companies where the consensus earnings expectations are too low, and we can confidently model the company in-house and develop earnings forecasts that are materially ahead of that consensus expectation. And we do have a small team here, small being the operative word, but I have an analyst, Mike Boots, who has joined me in November last year. And so the two of us are modeling companies with those core ingredients in place. And that's how we decide which stocks to invest in. Yeah.
And a plug for Mello here, actually, because I know that Matthew, who is one of your partners there, he's actually been to our physical and Mello events on a number of occasions. So he certainly enjoys them and says he picks up quite a few little nuggets there. So all the companies who come to Mello, it's always a good chance to meet with fund managers as well as individual investors. One thing all the audience are aware that they can ask questions as well. So do put your questions in the Q&A box and I'll try to ask them as we go along. But one interesting thing that has been asked, how does a fund manager decide what to do if things are not going as according to plan? Do you make a decision on whether you should be selling your holding? Do you try and be a catalyst for making change within a holding, or do you just ride it out?
Yeah, so the important thing is discipline. So there's a strong discipline to deciding which companies have the virtues that you believe can deliver value, and you've done the work to model the EPS and find that you've got that upside. Now, you've got to be constantly monitoring what's happening with the company. And if something deviates and deviates for the worse, then you've got to really look at that closely and find out whether that provides a further buying opportunity or whether it signals that what originally looked like an uptrend is now starting to fade out or indeed has stopped already. So it could be that the shares have done really well and you've got a high valuation, and oftentimes when companies have done well, management hubris starts to kick in, And it might be that they start doing less sensible things with a business and maybe making investments that are lower returning than their original investments that did well. Or it could be that market conditions change. And so again, that earnings drive and those inflection catalysts fade out, and it's time to move on. So that's the discipline, and that's how I approach the selling side of the equation. And on the flip side, there's always a lot of great new ideas bubbling away on the back burner, and they always knocking on the door trying to get into the portfolio. And that really gives the discipline to making sure that your existing holdings are still doing the job that you want them to do.
Yeah, it's the old story. Don't take on a new investment unless you've got space for it, really. And some of the others are underperforming, I suppose. There's only a limited amount of cash you've got available to invest at the end of the day.
Indeed.
And I mean, how do you go about selecting which companies to invest in? Have you got certain metrics you look for, or certain characteristics within a company?
Well, perhaps a good idea would be to build on what I was saying with an example. Typically, I know it's quite unfashionable these days to talk about price to earnings ratio, and everybody loves talking about EV to EBITDA, but the reality for an investor is the bottom line is cash flow per share. And what you're looking for with the price to earnings ratio is an approximation of that cash flow. And if the company is cash generative, then that will be a good approximation. So if I think about, well, CentralNic as a great example, I am a holder of those shares. And the reason I find it interesting is those strong characteristics. So something that they possibly just didn't really have time to really focus on in your meeting today is just how strongly positioned that company really is. Because they're talking about a very big market, but they are operating as very strongly positioned in certain niches of that market. So we all know about .com, but they talked about Slovakia. They are the .com owner of Slovakia. That is a very powerful and rich margin business. And then when they're talking about their online marketing, they're talking about domain name holders monetizing their websites. They've made two very substantial acquisitions that has led to a dominant market share position in a particular niche in a massive market, and a niche that is very highly valued by advertisers. And so by professionalizing that niche and bringing two different companies together with two different angles onto the same market, they've now created a very powerful proposition. So they've got a strong market position. I'll leave your viewers to judge if they consider that it's a strong management team. But in my view, the strategy is clear. They're bringing together those different organizations to create a whole that is able to accelerate organic earnings growth. And that's the key thing, the key catalyst for change in that company's share price. Because what we've seen over the last few quarters is that acceleration in organic sales growth, which is starting to lead into acceleration in organic earnings growth as a result of pulling that group together, investing into the combined entities to build teams that didn't exist before, to actually create more cross-sales benefit from that combination. And that is starting to come through with powerful sales growth that is much faster than it was in the past. And that should lead to strong earnings growth. And in this particular case, I think CentralNic is indeed cash generative. I think their cash does follow their earnings. When it comes to that question that they had about the cost of acquisition, it is quite unfair, the way in which acquisition costs are now accounted for. So in the past, you would pay your consideration for a company. You would buy that company, and you'd also add into that consideration all of the fees that were related to that purchase. So your all-in price, you might have paid 75 million for a company and 80 million overall. That 80 million is the right price. That's the cost of the deal. But now you have to do that 5 million through the P&L. And that's not helpful for understanding the underlying earnings power of the business. So I agree with their approach on that one. And so that's a great example of how we look at businesses like CentralNic.
Yeah. And do you have any other examples of ones that you've looked at and assessed in a way that you think is very beneficial, but maybe not been spotted yet?
Well, there's degrees of not being spotted, because we've got investments which have started to do well, but there's still very considerable long-term upside. And so the important point is that when you start to see a company doing well, you've got a much lower risk profile. So if you're trying to guess when a company is about to start doing well, you are taking the risk that you've got your timing wrong, and you might have to wait 1 year, 2 years, and then you've got your money in the wrong stock, and you're not making money in a stock that's doing well now. And so it pays to wait, because also something might go wrong between now and 2 years' time. It's hard to predict 2 years' time. It's quite easy to predict the next quarter and the next half and the next year. And that's what I was doing when I was looking at Gear for Music, which is an online retailer of musical equipment and instruments. And I was looking at this company in April, May of last year, just before we launched our strategies into the market, and became one of my leading investments in that strategy. And the reason for that is it was clear that as an internet retailer of musical kit, it was very powerfully positioned with the pandemic. But you'd have thought that the market would have fully recognized the benefit of that. But what the market didn't really factor in is that there was other change going on in that business. The management team had substantially improved the gross margin capability of the business. So they'd stopped overly discounting their products, and they'd expanded their own brand range, which is much higher margin. And also they'd finished an investment into CapEx to make their logistics much more efficient. So the same staff base could deliver substantially more product through to their customers. So all of that combined, and in the end, our in-house forecasts at the time of purchase was 5 times higher than the consensus expectations at the time. So the consensus was 10 pence against a 300 pence share price. So the market sold me stock at what they felt was 30 times, but I thought I was paying 6 times earnings. And it remains the case all the way through this holding period, which I still own the stock, by the way. We feel that the valuation is much lower than the still 30 times that the market thinks the stock is on. And so that's a great way of sustaining your trends in stocks that you hold, is to identify that things keep getting better. That gross margin continues to rise. The company is now making much more cash flow than it used to. So it can now invest that cash flow into expanding into Europe, and also adding acquisitions to extend its own brand range of instruments, such as Premier drums, Eden amps. These can be very rewarding acquisitions, I believe, for the company. And so that remains a very attractive position in the portfolio.
Yeah, I mean, I like Gear for Music. In fact, Andrew Vass, who, as you know, runs it, he was going to come to Mello, but we had to cancel, unfortunately, our event because of the pandemic. Otherwise, most of the investors would have been meeting him about 1.5 years ago. But you're quite good at spotting Gear for Music. I'm sure that's going to be a good company ongoing. And any other ones that you'd want to mention, maybe while you're looking at different companies?
Well, I guess generally speaking, I mean, what's exciting me at the moment in the market, there's various areas of the UK stock market where we're blessed with leading companies, leaders in the UK in their respective niches, but even global leaders as well. And so medical technology has been shown to be a very attractive space, a stock that I supported strongly at IPO, and has really come good in the last year or so, is Maxite. Very exciting times for them as they dual list onto the NASDAQ. So keep an eye on how that progresses. That's a leading cure for cancer company where they provide what seems like very futuristic gene editing technology that is allowing the creation of hundreds of different drugs as a platform, which their customers are worth tens and tens of billions of dollars. Maxite is not worth that much at the moment, but in theory could capture a greater share of their customers' market cap. And then you've got green energy. There's a number of green energy companies that started life out in 100 million market cap or so, are now billions, still in the UK, like Ceres Power, ITM Power. But looking at the next generation, AFC Energy has been doing very well as a leading player in alkaline fuel cells. But in Invinity Energy Systems in vanadium flow batteries is also doing well in that space. There's some important news recently was that they secured a partner in the form of Siemens. So Gamesa Siemens is a major player in wind farms in particular. So that's an impressive credential that company enjoys. But yeah, there's many different stocks with leading positions on the global stage.
Okay, well, we've got some questions from the audience, and a reminder, put them in the Q&A box and I'll endeavour to ask them. Now, Ben Sharman wants to know, when you're deciding to invest in a small cap company, which is the most important to you, the valuation or the management?
Of that choice of two, I'd say valuation, because it's very hard to make money if you overpay for the investment that you're making. What I would say is something even more important than both of those is the starting point, which is a strong market position. So if that company has that strong foundation, everything that's good from the company will spring from that point. I think it is the case that it's Warren Buffett, I think, who says, if you've got a choice between a good company and a good management team, pick the good company. Ultimately, a bad management team on a good company is likely to do better than a great management team on a bad company. So that's from my point of view. You want to have that. You want to have that strong tailwind in place before you then evaluate if it's cheap, and if it does have a good management team that could do even better with that strong position that they have.
Yeah. And I know from my own side that I like to catch up with the management teams. I like to see the whole board, to be honest. I like to see the quality of the non-execs. How often do you get to meet the management teams?
Well, we're very fortunate that, especially in this era of Zoom, it's become even easier to meet with the management teams of companies that we're considering investing in, and also the teams like Andrew, who we've backed and keep getting updates from. So yeah, I think it is a great benefit of being a professional in the investment industry, that you do get the privilege of meeting these otherwise very busy individuals, and they're very passionate about their companies, give you that great insight into what's driving the success of their business. So yeah, it's valuable, but what you need to bear in mind, I believe, as an investor, is don't get caught up in the slides and the presentation, and don't back a team just because you think they present well. It's understanding the fundamentals of the business that really drives value creation and strong share price performance. So sometimes, and I've liked this to do this quite a lot, it's actually companies with bad presenters that I favor, because I'm focusing on companies that I think have got those strong qualities that I've discussed. I like it if they're bad at presenting. It means that they've probably got room for improvement. And so over time, they will get better and better at presenting, and more people will decide that they like the company. As long as the management are capable and can do a good job, and preferably be very capable and very good at creating value, then that's the main thing as far as I'm concerned.
I agree with you wholeheartedly. In fact, I would say the reverse also applies. I think you can get very slick presenters who certainly get to the share, will get the share price to places it probably shouldn't have gone. And that's knowing when to sell. That's a valuation situation. But yeah. Now, Peter in Guildford wants to know, how do you measure your performance against which indexes or indices? Do you have certain ones that you like to see you're beating, or do you have maybe other management teams you want to know you're beating, I guess?
Yeah, so I would look, I can answer in respect to my historic funds that I managed. I always would look against the numerous smaller companies plus AIM index, X investment trust total return, to give it its full title. And the reason for that is that genuinely covers the whole of the smaller cap market. So the Numis index, it's not the same as the FTSE. It starts from the bottom and goes up instead of the FTSE, which starts at the top and comes down. And so what they're looking for is they look at the whole market value and chop it up and look at the bottom 10% of the market by value to determine what is characterized as smaller companies. And that gives you 1,000 investment options when you include the AIM listed companies in there as well. And that gives you an enormous amount of choice. And it also gives, from an index point of view, is fully capturing the whole universe of choice that an investor has. So if I was trying to measure myself against the main listed companies only, I wouldn't want to be prevented from investing in AIM listed companies, because there's a lot of very, very good companies there, and a lot more by percentage than they used to be 10, 15 years ago. And so it's important to have an index that includes those.
Mentioning AIM there, do you think over the years it's got itself a bad name for some reason? Because, quite a few investors will say, well, that's the Wild West of investing. I'm happy with AIM, but, there are a varied number of companies on it. I love family firms that have been well run over the years, but everybody has a different thing they're looking for. How do you feel about AIM?
Well, I'd like to think that AIM's reputation has only improved over time, because I think that Wild West characterization, that difficult, low quality perception was perhaps valid in its very early days, and probably almost intentionally so, because it's called the alternative investment market. It wasn't intended to be mainstream at that point. But of course, what happened is that the tax incentives resulted in a boom of IPOs onto the AIM market, particularly 05, 06, 07, for those of us who remember that time. Lots and lots of new companies came on. And what sprang from that is that a lot of those companies were choosing AIM for the tax-related reasons. So they could have easily been on the main market, but chose not to be. And the other fact is that a lot of these companies that started out life as quite speculative, maybe non-cash generative, but with entrepreneurial teams with great idea, well, some of those actually worked. So of course, some of those didn't work and they've fallen by the wayside, but the survivors have grown very, very strongly and become very investable businesses. So from my point of view, I really don't distinguish between whether a company is main listed or AIM listed. I haven't never really noticed enough of a difference between those two markets. For the same size market cap, being on one market or the other doesn't really seem to make a difference when it comes to identifying a high quality company that can deliver high growth.
Very good. And I mean, many of those listening to you will have course been impressed. They'll wonder, how did you get that name, Raynar? Where does that come from? You've got a Scandinavian background as a backdrop. Where did you get the name? Does it mean something in?
Well, I don't know if you can see with the resolution, but within the R is a radar or sonar symbol. So the name Raynar is a combination of radar and sonar. And our cheesy strapline is we search high and low for great investments. And I guess when I think about my preference, I like to look under that waterline. There's a lot of stocks that are quite visible in the skies, but not necessarily as visible below the surface. And it's only occasionally when some of those small companies break through and become those big stars. But we want to be trying to find those that make the grade. And so a teeny tiny company, make no bones about it, but we've picked the largest animal that's ever lived on planet Earth as our mascot at the moment, the blue whale. So hopefully that alludes to our aspiration. But and the Nordics, well, it's a wonderful part of the world, and it was an inspiration for the logo choice.
Great. Well, that explains it. And I mean, overall, I mean, everybody listening, I'm sure, has been very pleased with what you have to say, and they like your sensible approach to investing. But how are they eventually going to be able to invest in you? Have you got any sort of guidance you could, well, not guidance, but any timeline? Where's the future for us all to be able to invest?
Well, in the past, I've offered a range of products that has been widely accessible in the UK market. The one I enjoyed managing the most was the microcap investment trust. Something that I conceived of. I created that trust, designed its special features, and IPO'd it a few years ago now. And at the time, I put 100% of my SIP into that IPO because I believed in it so much. And very pleasingly, it became one of the top performing investment trusts in that sector. So given that I enjoyed it so much, perhaps it's something I want to revisit in the future. Certainly can't give you any timelines, but all I can say is watch this space.
Excellent. 100%. So you're all in on that one. So that's good. I think investors like to know that the fund managers have got a lot of skin in the game as well. It's always good to hear. Okay, well, thanks, Philip. First time on Mello, but we've enjoyed having you with us, and we'll watch this space, as you say, and see how we go. But we'd like to get you back, I'm sure, in the future. So thank you very much.
Thank you very much for having me.
Thank you. Okay, well, now we've got another company presentation. I think we've got Tharisa next.
Good evening, David.
Oh, there you are, and we've got Phoebus with us. Great. Excellent. Do tell us about Tharisa. I'm sure there's quite a few that have never heard of Tharisa, so it'd be good to know all about it.
Well, good evening, everyone, and it's a great pleasure to share our company with you this evening. Please, can you confirm that you're able to see the slideshow presentation?
Yeah,
fantastic.
We've got your screen, yeah. And there's currently 307 on the webinar with us, so we're looking forward to it. Thank you.
Fantastic. Thank you, David, and thank you all for your attendance this evening. I'm sitting here in a bit of a cooler Johannesburg than sunny London. So just from the outset, I think one of the reasons why we wake up every day is to make a difference. And to that end, we really believe in the fact that we're enriching lives through innovating the resources company of the future. And really, timing has never been better for resources. You know, everyone thinks that technology and the green revolution will happen through digitization, but the raw materials that are required to move us from a carbon emitter to a carbon neutral footprint are the very same metals that are required and that we are so proudly part of the value chain. So it's the right type of mining, the right commodities at the right time. So if you look at who we are, we're an integrated producer and miner of platinum group metals and chrome concentrators. Now, it's important to differentiate us from other peers in the industry, and that is in the fact that we co-produce. So we don't produce one as a primary product and the other as a byproduct. We focus on maximum value extraction of both platinum group metals and chrome concentrate. We've been in this industry for many, many years. This particular mine, the Tharisa mine, which is our flagship mine, has been operational for 10 years. And I think what gives us a competitive advantage is the fact that we have 14 years open pit life of mine. And this comes with a number of strategic advantages over deep level mining. So on average, the platinum industry in South Africa is 1 kilometer below surface. That has a very different risk profile, very different cost structure, and we'll unpack that slightly later. After the 14-year open pit life, we've scheduled a 40-year underground mine, and that's really not limited by the resource scale or size, which, as you can tell, is massive at some 860 million tons, with contained metal of some 43 million ounces of platinum group metals and 172 million tons of contained chrome. I think this co-production, low-cost business model that we've had has really proven its resilience, and we have maintained profitability throughout the cyclicality of the commodity pricing environment that we operate in. And I think it's a key attribute of this business is that we're in the lowest cost quartile. I think we're also pleased, and our shareholders hopefully are pleased as well, that we're a consistent dividend payer, and this will mark our 7th year of paying out dividends. You'll see the map in South Africa. We're located in the Bushveld complex, which is really the heart of chrome and platinum globally. And we're in the southwestern part of the Bushveld complex with potential opportunities in Zimbabwe, which we'll unpack a bit later. A lot of talk around ESG, and very proud to present to you the fact that we have, from the outset, embraced the environment, the sustainability of our business, and the governance within which we operate. I think the fact that our communities own 6% of the project that we refer to as Tharisa Minerals, the main producing asset, really talks to the lifelong commitment that we have to this community. In this last financial year, which is a September year end, we spent $1 million on community upliftment. We've provided infrastructure and services to the community. We employ more than 700 people directly from the local community. And education is a key factor for us and a key pillar for development. And to this end, we offer adult education training. We have 35 adults enrolled currently in our program with 98 internships, and those are graduates and learnership programs that we offer. Safety is a key component to any mining operation or any industrial operation. And we often say a safe, healthy mine is a productive mine. And to that end, we're very pleased with the milestones that we've achieved, and that is a 5-year fatality-free, 5 million fatality-free shifts. Recently, on the 1st of June, 2021, we achieved that milestone. Importantly, all our employees are registered and enrolled in private medical aids. In this last year of the pandemic, we invested in a clinic as well as isolation and quarantining facilities to cater for our own employees and, in some instances, the community. We provide sanitizers, protective gear to our local community, and we support the schools within the area. When we look at our contribution to our government and the governments within which we operate, we pay taxes and royalties of close to $52 million. Our wages and salaries, almost $90 million in the last 2 years. And importantly, all our employees are signed up and enrolled in a company provident fund, which is basically a retirement annuity fund. When we look at the environment and we look at decarbonizing our footprint, we're extremely committed to this. And in fact, a number of our R&D initiatives are focused on using the metals and the commodities that we mine to provide greener solutions. And a point in case is the platinum group metals, reducing emissions by limiting carbon and noxious gases from tailpipe emissions. But we have embarked on a journey right now where we're looking at delineating a roadmap within which we can clearly articulate our carbon reduction over the next 10, 15, and 20 years. I think we're pleased that we report on scope 1, 2, and 3 emissions, and we will be focusing on scope 1 carbon emissions in terms of our roadmap going forward. When we look at our business and we look at the foundations of sustainability, and we really do believe in sustainability, I think the fact that we have this long life, long resource through the ore body that we've been blessed with gives us the sustainability to continue to deliver value to all stakeholders. We run a modern mechanized fleet with low labor intensity. And one of the key areas that we're looking at in terms of our decarbonization strategy is looking at alternatives to diesel fuel, be that synthetic fuels, hydrogen, and even battery electric vehicles, or a combination of the two. But our focus, moving from the discovery of the resource, developing the mine, is also on maximizing the return and the recoveries. When we talk about recoveries, we talk about the percentage of the metal content that we extract from the ground. And it's something that we're very focused on and in fact obsessed with when we look at the value that we can extract from every cube of rock that we mine. There's a huge amount of effort and energy that goes into extracting each cube of rock. And our view is that you might as well maximize your opportunity to extract value from that cube of rock. We also have wholly owned subsidiaries which focus on logistics, as well as marketing, sales, and beneficiation, research and development. And we believe that these add value to the whole Tharisa story. So we go beyond just mining and selling our commodities at the mine gate. We engage with end users, end markets, product development, looking at niche opportunities. When we look at our core pyramid of value, we really underpin this with capital discipline. We believe we have 3 pillars really in terms of our capital discipline. We provide returns to shareholders in the form of dividends. We recently announced an interim dividend of $0.04 on the back of our very strong half-year numbers. And to date, we've paid out just under $49 million to our shareholders. So the intent is there to continue to pay out in terms of our stated capital discipline, our dividend policy, which is to return at least 15% of net profit after tax to shareholders. And you'll see over the years, we've exceeded that metric by paying out on average just over 17 or closer to 18% in terms of that return. We invest in our business. And I think this is very important. It is a capital intensive industry. Stay in business CapEx is relatively large component, but we continue to invest in our mining capacity in terms of yellow fleet, human capital, and most recently in the very exciting fine chrome recovery plant referred to as the Vulcan plant, which we'll touch on slightly later. And then the third pillar is our growth opportunities. We look at organic growth, maximizing those recoveries, optimizing, installing these unique processing circuits to extract even more value out of that material that we feed through our processing plants. Then we look at downstream opportunities in terms of our platinum group metals, focusing on beneficiation, producing an alloy and then a refined metal that we can on-sell. We're looking at new products in terms of steel and stainless steel through our chrome ore production. Then we look at external opportunities, which I have a few slides on later on. If we look at our half-year results ended March of this year, by all accounts, our best financial performance to date, but also operationally very strong and really starting to reap the rewards of the effort that we put in over the last 2 years in terms of investing in our open pit, investing in our people and yellow fleet, and very pleasing to see the results improving from the comparable period. We mined 2.5 million tons of reef. We produced 75.1 thousand ounces of PGMs and 730,000 ounces of chrome. We've just released our Q3 results, which I will share with you in the next slide. I think in terms of magnitude, this is a relatively large business. Revenue at $313 million for the half year, generating an operating profit of $104.5 million, and pleasingly an EBITDA of $124.2 million. All of this resulting in operating cash flow of just below $105 million and an earnings per share of 21.4 US cents. We look at our business and the efficiency of our capital invested in terms of return on invested capital, and we're very pleased with that number, which exceeds most returns, be it in most asset classes, at 35.1%. At the half year, sitting with net cash over $29.8 million, and that picture's improved as at the end of our Q3 production, with positive net cash sitting at $41.8 million, cash on the balance sheet at $80.5 million, and that's post the $10.8 million interim dividend that was paid out. So in a very cash generative position at the moment, enjoying buoyant commodity prices. PGM spot prices for the half, actually for this last quarter, were $3,600 an ounce, up from $2,800 for the previous half ended March. So nice improvement. Currently prices trading slightly down at just around $3,000 per PGM basket ounce. I think importantly, chrome prices have appreciated and improved. Currently spot prices at $165 per ton. For the last quarter, $160, and for the half, $155. So seeing a positive trajectory. And in terms of our guidance for the full year, we believe we're on track to meeting that guidance of 155,000 ounces minimum to 165,000 PGM ounces. We produced just under 115,000 PGM ounces for the 9 months. So forecasting a strong fourth quarter, and similarly produced around 380,000 tons of chrome, our best chrome concentrate production on record, giving us just over 1.1 million tons, again on target to produce that 1.45 to 1.55 million tons of chrome for the full year. If we just unpack the platinum group metals, there's 6 elements typically that we report on in terms of our PGMs, namely being platinum, palladium, rhodium, ruthenium, iridium, and then we add gold in. Typically at Tharisa, we have very low gold loadings. But I think what's important to note here is that South Africa is key to the supply of more than 80% of the world's platinum and rhodium. And these are very key components, not only currently for the internal combustion engine, but also looking forward when we look at the hydrogen economy and we look at fuel cell technology and electrolysis of water going forward. I think the talk around, the death of the internal combustion engine is a debate and a topic that we could have for hours, but there's no doubt that there's a lot of momentum behind the green economy, and hydrogen has a vital role to play in decarbonizing our footprint as a planet. To that end, the minor platinum group metals, namely ruthenium and iridium, will be the net beneficiaries of that drive, not only because of hydrogen, but because of technology as well, with the rollout of 5G as well as electronics. We see the use of these very, very special and unique elements. If we look at BASF's forecasts in terms of market balance, and you've got in the bottom right-hand chart, you see those 3 lines, platinum, palladium, and rhodium. You see currently palladium in a deficit below the line, rhodium forecast to be in a deficit for the foreseeable future, and platinum, which excludes investment ounces, which is your coin, bars, and ETFs, sitting in a surplus currently. We see that dynamic changing as the transition moves into that green economy. Some people have pushed it out further to 2025, but be that as it may, there will be this ebb and flow between the various constituents of our PGM basket, but nonetheless, all critical and valuable in their function and form in terms of either emission control or the green economy going forward. So how are we positioned in terms of the global PGM world? Well, we have a large resource, some 43 million ounces, as mentioned. As per our full year results from 2020, we're positioned as around supplying about 1.3% of the world's platinum demand, 0.3% of the world's palladium demand, and around 2% of the world's rhodium demand. You can see we're situated in platinum and chrome country with Sibanye, Stillwater, Impala, East Platts, and Anglo as our neighbors further to the west. But I think what's important also is to look at our split of these four elements on a 4E basis: platinum, palladium, rhodium. And to that end, we have a very favorable ratio of platinum, palladium, and rhodium. And that gives us one of the most valuable 4E basket prices in the Bushveld complex at some $3,478 as at the 12th of July. When we move to chrome, we are a significant producer of chrome, and we're a key brand name in the supply chain of chrome. Chrome is irreplaceable. It is what makes stainless steel stainless. South Africa hosts 70% of the world's chrome reserves. What's interesting, China, as the biggest terminal market and the largest stainless steel producers, producing 60% of the world's stainless steel, have zero chrome resources. So they are wholly dependent on the importation of chrome units, either in the form of chrome to be converted to ferrochrome or a refined or beneficiated product in the form of ferrochrome. Most of the supply comes from South Africa for that Chinese economy, but we're also a big supplier into Indonesia, the other stainless steel producing territory, which has grown significantly over the last decade. And really, stainless steel has been driven by domestic consumption in China. It isn't necessarily an export-driven fundamental, which really gives it resilience. And we saw that during the global slowdown during the pandemic last year, where China rebounded much sooner than the rest of the world, and we saw demand pick up almost immediately in terms of chrome units. And it's really broken down into consumer goods, catering, chemical, petrochemical industry, and then construction and architectural applications. In terms of the market dynamics, South Africa is the dominant supplier at 80% in 2020, and China, as mentioned, 90% coming, imports coming in from ore produced in South Africa. So how are we positioned? We have a very large, if not the single largest chrome resource from a single mine at 177 million tons of chrome. As mentioned, we are a significant producer, but being a significant producer also has exposed us to the stainless steel industry. And we made a conscientious decision and a conscious decision to diversify our chrome products. And this was really done through our R&D team. We constructed the Challenger plant to focus on producing what we refer to as specialty chrome concentrates at around 24% of our production. And these go into the chemical and foundry industries. What's great about these products is they command a premium over the metallurgical grade of between $30 and $50 per ton, and they're globally diversified. From the North Americas to Europe to India and Asia. So very pleased with our market position in terms of those products. You can see a photo of the construction of our Valquin plant. This is a technology and a process that was developed in-house and really talks to our passion of optimizing recovery. And what this processing plant, which is a fairly significant footprint, will achieve is the recovery of ultrafine chrome, which we currently deposit on our waste storage facility. This is around a $46 million CapEx program, and we are anticipating completing this construction by September and commissioning this plant before the end of the year. It is a significant plant in terms of its output. It gives us an additional 400,000 tons of saleable chrome concentrate on an annual basis, basically a 20% increase in our production at a very low operating cost, because it is a tailings retreatment process. I'm not going to spend too much time on this slide. It's very detailed, but really what we want to illustrate here is the longevity of this business. We've spent a lot of capex, we've invested in this business over the years, and it's starting to pay dividends literally and figuratively in terms of output, in terms of its cash generation and its ability to withstand the volatility in commodity prices. I think what's important to take away from this slide is that there's a growth in our PGM production profile. We're targeting 200,000 ounces from 2023 onwards, or financial year 2022, and 2 million tons of chrome. And that is really the optimal state of operations at the Tharisa mine. And we can sustain this for the 14 years open pit mine and then transition into the 40-year underground that we've scheduled so far. But those plans will be refined closer to the time. When we look ahead at our growth opportunities, we see that the most value that we can extract is by beneficiating our platinum group metals. Like most junior miners and startup companies in the platinum group industry in South Africa, you are obligated to find a home for the concentrates that you produce, and typically you'll end up signing a life of mine offtake for these PGM concentrators with the big three refiners in South Africa. Fortunately, we had the foresight not to sign a life of mine contract, and to that end, our main contract expires next year in October. We have been running a demonstration smelter, a 1 megawatt smelter depicted in the right-hand side there, for the better part of 3 years, really proving a low-cost, efficient downstream beneficiation of our platinum group metals. It is run on a semi-commercial basis, on a shift basis, and we're currently upscaling that and moving it to a site closer to the Tharisa mine in anticipation for the larger full beneficiation complex. Why are we doing this? Currently, we receive a percentage of the contained metal value in our PGM basket, so that $3,600 ounce is the list price or the published prices of the PGMs. We receive an order of around 81% of that basket price. The balance goes to the refiner and the smelter of those PGMs. So we believe through the studies and the work that we've been doing that there's a significant margin to be gained by going downstream and refining our product in the order of 15%. And if you do the numbers, you'll realize that there's a significant kicker to our margins and to the business as a whole. Furthermore, it gives us access to end users, end markets, and niche technologies, which is something we're very excited about in going into the future. We also have been doing research on chrome beneficiation, looking at new opportunities to beneficiate chrome, looking at new applications and new developments, and we'll be excited to share those with the audience and the public in the future once we have gotten through those various trials and tests. We have signed an option with Selene Manganese and Iron Ore. This is a very neat operation in the manganese and iron-rich region in South Africa in the Northern Cape. It is a producing asset. We've got an opportunity to acquire 70% in terms of the mining legislation. The balance is held by Black Economic Empowerment Partners. And really, this is a simple operation. It's a direct shipping ore, crushing and screening mining of both a high iron manganese and a high quality iron ore. And it is cash generative as we speak. We think it's very complementary in terms of our terminal markets, in terms of the opportunities. There is a resource declaration underway from Selene themselves, and we are busy conducting our feasibility on this option and determining whether it is a viable fit and what the economics will be. And we'll share that with our shareholders and interested parties in the future. In terms of the opportunities in Zimbabwe, the one that excites us the most, and if you're in the platinum industry, really there are two jurisdictions that have really been bestowed with resource wealth, and that is the Bushveld complex in South Africa and then the Great Dyke in Zimbabwe. And we're pleased that we've taken a 26.8% equity stake in Karo Platinum. We've completed 2 phases of exploration, and we have been in financing discussions for the project. And the idea here is really to roll out a very measured, low-risk operation on the Great Dyke. So if we look at what we've achieved so far as a collaboration with Karo and Tharisa, we've managed to secure a special economic zone over the region, which gives us a number of fiscal incentives in reduced tax rates, duty-free importation of raw materials and equipment, and importantly, the ability to keep all our foreign receipts in hard currency. We will also submit a national project status application once we've completed the feasibility and implementation study. So one of the big questions we get is, where are you? When are you going to give us more details? What's happening in Zimbabwe? So the key milestones, and we're hoping to present all of these results by the end of August or beginning of September of this year, is to declare a resource and reserve statement, SAMREC compliant, the publication of the implementation study, as well as the completion of the financing of this project. What are we focusing on? We're looking at a similar rollout to Tharisa, where we're looking at a 10-year plus open pit life of mine to start with as phase 1, and a very quick execution and development timeline of some 24 months. I think it's important to note that Impala Platinum, Anglo Platinum, and Sibanye-Stillwater operate successfully on the Great Dyke and are neighbors of this property, and have done so for numerous years and decades, in fact. Adjacent to the Karo property on the Great Dyke is Selene Chrome on the east side, which is the Chrome prospective area, and is where we've started with the development of our Chrome project at some 11,900 hectares. The plan there is we've allocated $5 million. That includes the capital for the processing plant, which is a small chrome spiral plant, as well as working capital. What's exciting about this is it's a very niche project, and we should be in production before year-end 2021, producing between 7,000 and 10,000 tons of chrome. And this really gives us a niche product which commands a premium over our South African ores. There is an area on the west side which historically has been mined for gold, nickel, and copper, and is prospective for that, a very large area. And we've started with some desktop exploration studies there. So very exciting on the mineral-rich Great Dyke outcrop and adjacent to that. So we'll keep you updated as to the progress on that. So David, just in conclusion, and I hope I haven't run over too much, I think the team has proven that we can develop, discover, and bring projects to market, and consistently manage these projects throughout the cyclicality of the commodity cycle. I think currently we have a great business model in the co-production of PGMs and chrome. We do benefit from operating in a weak foreign currency environment. The South African rand gives us a buffer in terms of our costs being deflated, and an export or a US dollar denominated export price. We have very strong cash generation, particularly now with robust PGM prices. I think we committed, and we're completely aligned with our shareholders in terms of investing in our business, but also balancing that investment with returning cash to shareholders in the form of dividends. Our balance sheet is in a very strong position, and in fact, perhaps a bit lazy at the moment. And we have a very exciting growth profile, which I've unpacked a bit more during this presentation than historically. So with that, I'd like to thank you all for your attention, and hope I've managed to enlighten you around the platinum group metals and chrome opportunity that Tharisa presents. And And David, hopefully it was a bad presentation, because Philip said we
yes,
bad presentations.
I know where you're coming from, as Philip mentioned, but it was a very good presentation. The only problem is you've used up all the time with it. So I have to tell you, you've got about 16 questions here. So clearly it's been really popular, but I don't unfortunately have time to ask them all. I'm going to ask you one,
Sure.
but we will try, and obviously, well, we will get the questions to you, and if you can answer them separately, we'll put them on our website so that everybody will see them. So the one question I'm going to ask is, it's about the, let me get it right. Your PGM revenue is largely dependent on the price of rhodium, which is now 40% off its recent highs 2 months ago. Given rhodium price is so volatile, how do you remain certain that you can maintain or exceed current profitability?
So it's a good question and very topical because of the volatility that we've seen. You know, none of us expected rhodium to reach a $30,000 per ounce price level, and we certainly didn't believe it was sustainable at that level in perpetuity. Now, the recent sell-off really is on the back of two factors, we believe. One is profit taking from speculators that entered the market. It is a very illiquid market. It trades by appointment. It's a very, very small user base that utilizes these rhodium ounces on the one hand. And then secondly, the chip shortage, the semiconductor and superconductor shortage has meant that auto sales have had to be curtailed and outlooks for supply have been cut. And so those two factors have really had a dampening effect on the rhodium price. We are still firm believers in the fundamentals because the supply side hasn't changed and is constrained and will remain constrained. What we're seeing now maybe is a temporary correction. We do believe that prices should retain high levels, but nonetheless, David, we still remain profitable at these levels and enjoy, you know, exceptionally high margins on rhodium. And one has to look at the history of the rhodium price. In the mid-2000s, we saw a boom again on the back of emission control standards, and then a retreat in terms of those prices. So I think one has to appreciate that commodities will be volatile, and particularly in this uncertain environment. But how do we predict profitability? The only way we can manage that is by managing the controllables, and that is managing our costs, managing our productivity and our output, and making sure we constantly improve and optimize and benefit. And being in the lowest cost quartile is the remedy to price uncertainty and volatility, in our view.
Okay, well, thank you for that. Certainly we will save all the questions here. With 320 on the webinar, you're bound to have questions, but I'm amazed at how many we've got. So we'll do our best to get answers for all of these. You've been very popular, and thank you for joining us.
Thank you so much, David, and thank you to the audience.
Thank you.
Take care. Have a good evening.
Great. And now we've got a company that I can admit I've been invested in for many, many years, probably about 15 years. And I know Alan's been invested for quite a while too. Welcome, Jim. Good to see you.
Good evening, David.
Yeah, and Jim will admit I've been trying to get you on Mello for what seems like years and years. I'm sure it's a good few years, but
I'm here now.
Good to see you. Good to see you. And over to Alan, because Alan's got quite a few questions for you, Jim. We like to do these interviews. It's always good to have the CEO on to answer them. And let's see if everybody also has a few questions. We can get a few in at the end. That last one was lots of questions, but I just couldn't get them in. But anyway, go for it, Alan. Let's hear all about Tandem. You're on mute, Alan, I think.
There we go. Good evening, everyone. Yeah, Tandem. I'll first of all just give a couple of minutes introduction using the Stockopedia page that most of you are familiar with. First of all, you see in the top right-hand corner here, the stock rank is very high. It's 89, with actually a quality rank of 91, which is really driven by a very strong return on equity, return on capital employed that it consistently achieves. Also a very high value rank, which we'll come to talk about a bit more going forward. You see just to the left of the stock ranks there, the market cap around 28 million. The company has had at the end of last year around 3.8 million of cash on the balance sheet, net cash, so that leaves the enterprise value at about 24.5 million. And you see the share price graph here, that really the shares were trading in a range of sort of £1.20, £1.50 for a very long period of time, and really got ignited in about May last year, and they went all the way up from sort of around £1 at the lowest point, right up to £7, and just in the last couple of months it's eased off slightly again now to be £5.30 as we speak. And I think the big driver of that share price performance has come when you look at the financial summary below and what's happened to the operating profit and actually the profit before tax of this business. Now, this business has actually been profitable every year going back to 2007, but really for about a decade, from 2007 through to 2016, the average profit was around £1 million. And then in 2017, there was quite a big step up to 2 million. By 2019, it got up to 3 million. In 2020, last year, it was up to 4 million. And indeed, a couple of weeks ago, there was a very strong trading update on the first 25 weeks, and sales this year are 14% above last year, and with an order book that's actually more than 3 times higher than it was at this point last year. So hopefully that progression in profit to continue, but a real step change that started from 2017 and moving forward. And eventually the share price really started to catch up with that story and has motored forward. But the final thing to point out before I move on to my questions, if Anne could just move it down again slightly, is the price earnings ratio, that despite that progression in profit, despite the very strong balance sheet that the company's got with net cash and freehold property and the growth it's been achieving, the PE ratio is still only around 8.5 on last year's earnings, obviously, let alone what it might be on the next year's earnings. So that's on last year's earnings, only on a PE of 8.5, and certainly those earnings convert very strongly into free cash flow each year as well. So that's really what drives it, having a very high value rank on the stock ranks. Okay, so enough of me talking. I'll now move on to my questions. So first of all, good evening, Jim, and welcome to your first Mello. Would you first start off by giving us an overview of the business and what Tandem is and what it does, especially for those of you in our audience who might not be familiar with it?
Yeah, absolutely. Good evening to you. So we design and develop products across 4 key product categories. We have our toy, sports and leisure products, bicycles, home and garden, and e-mobility. Manufacturing is outsourced, mostly to the Far East. So therefore, we have significant skills in importing that product, which is clearly very useful at the moment. We have a Hong Kong office where we undertake QA, QC, inspection and shipping type activities. And then once we've got that product into the UK, we distribute and we retail via a number of channels, from large national retailers through to smaller independent customers, and also direct to the consumer. In terms of products, we sell both character license, mostly wheeled toy products, and we also have our own brands. Some of our well-known licenses, I guess, that viewers would be familiar with are Batman, Disney Princess, Frozen, Paw Patrol, Peppa Pig and Spider-Man. And then we have a number of our own brands, which we attribute to those 4 key product categories. So, for example, in our toy, sports and leisure area, We have a brand called Headstrong, which is outdoor play. We have another brand called Kickmaster, which is kids football training. And we have a couple of scooter brands, Stunted, which is more for stunt scooters, and U-Move, which is for the preschool market. We also have a golf business called Ben Sayers, and Ben Sayers Golf has done particularly well throughout the last year. On bicycles, we also have a number of own brands. So we own Doors, Claude Butler, Squish, which is our children's lightweight range, Falcon, Townsend, Boss and Ellswick. And then in home and garden, we have several brands, Airwave, Jack Stonehouse and Pro Rider, where we sell gazebos and party tents and various other sort of small domestic appliances for the home. And then our fourth category, e-mobility, we sell e-scooters, e-bikes and mobility scooters using our Life brand, our Wired brand, and Pro Rider. So in a nutshell, that's broadly who we are and what we do.
Okay, great. Thank you very much. Now, I know a lot of people who I talk to Tandem about often say, oh yeah, of course it's bicycles, but I know that is only a part of the business. So what would be the broad split of revenues by your major product categories?
I guess if you look at those four key categories, toy, sports and leisure accounts for approximately 40% of the group at the moment. Bicycles is around 30%. The home and garden area is about 20%, and then e-mobility around 10%. But obviously, you know, they change as time sort of progresses. Certainly last year, bicycles has been particularly strong. But broadly at the moment, that's the split.
Okay, excellent. Thank you. Now, when I was introducing you a few minutes ago, I talked about that history of your profit, really, how you consistently made around £1 million profit every year for up to about 2016. Then 2017, you had this step up to 2 million, then it went to 3 million, and then by last year it's 4 million, and hopefully sort of moving forward again this year. So going back to 2017, when there was this really appreciable step up in your performance, what was it that drove that?
Well, we've been through quite a detailed strategic planning process. We identified a number of key areas for growth. Certainly the bedrock of what we do is maintaining and growing licenses. We've got some very strong licenses at the moment with, as I mentioned before, Peppa Pig and Paw Patrol. We signed Disney and Marvel in 2018. So those licenses for the likes of Frozen and Disney Princess, Toy Story, Spider-Man really contributed quite strongly to revenue. And we've had other strong licenses. LOL Surprise has done very well for us. Batman was strong last year. So, I mean, certainly in terms of a key objective, licenses are very important to the group. We also wanted to expand our license range, which, as I said at the start, is predominantly wheeled toys out into other areas. So we've moved into tents, suitcases, teepees, and also e-scooters. And we wanted to develop our own brands also to complement our licenses. So the brands that I did mention earlier, Stunted, U-Move, Life and Wired, are all relatively new and have identified a pocket of the market to target for us, and that's obviously generated additional revenue. We have been acquisitive. In 2014 and 2015, we bought 2 online businesses, and that's been the genesis of our B2C operation, which now accounts for sort of 20-25% of group turnover. And therefore, I think, you know, we are conscious that buying other companies can really contribute to the group's growth. Bicycles has been particularly strong for us. Our Squish lightweight range has generated good revenues, and that was introduced to the market in 2017. So we've been particularly pleased and excited about how that's developed. And certainly the resurgence of other bicycles in 2020 through the lockdown has really sort of helped, particularly with that order book, which you mentioned. And then I guess the ongoing investment in our direct-to-consumer side of the business has been important to keep that growing. And of course, we try and control our costs very well. We have 73 members of staff at the moment. So we're a very small business, but they're all very committed and dedicated and really help us get to where we've got to in the last few years.
No, excellent. Now, Jim, I noticed there was an RNS 3 or 4 months ago now, which was a very important RNS actually, highlighting that you were going to be buying a lot of freehold land around your current warehouse in Birmingham, and to develop that warehouse, so big capex spend to really expand the warehouse and double the capacity of that central warehouse. Now, what was the rationale behind that?
The rationale was twofold, I guess. Firstly, a financial rationale. I mean, we expect that acquisition of the freehold land and the subsequent development of that into a warehouse will be earnings enhancing. We think at the moment it will save us at least £200,000 a year. So, it's important from a financial point of view, but equally, and I would say as important to us as a business is the commercial side. We utilise third-party warehousing at the moment in Felixstowe, and whilst that has been good for us, and certainly when you don't have much stock, which has been the case for bicycles over the last year, it is quite cost-effective. In the longer term, it doesn't give you the same control that having your own warehouse does, and having your own building means that you can utilise and allocate warehouse labour quite efficiently. It gives you scale economies with multiple carriers picking up multiple products from one location. We think the carrier hubs in the Midlands are quite good compared to other parts of the country, which would help us. And our ability to dispatch different product ranges to the same customer, for example, is a massive positive for us. So I think there are a number of commercial benefits to doing it. Equally, it gives us greater group-wide thinking on general product development and product strategy. And to be honest, if we look at our existing warehouse, the premises aren't big enough if we want to grow our domestic business. And certainly with our direct-to-consumer operation, which is growing, we think this gives us the platform to be able to do that, really.
No, perfect. I referenced at the start as well your very strong balance sheet, which has already got freehold value of about 4.2 million, I think, even before this expansion we've just talked about. But obviously also net cash of around 3.8 million at the end of last year. Now, also recognise with the levels of profit you make, that actually a very good proportion of that profit does drop through to free cash as well. So you've got a big cash balance on the balance sheet. You're generating cash strongly. What are your plans for doing with that cash? How are you going to spend or invest it?
Okay. Well, I mean, firstly, I think we've heard from the other presenters this evening how important cash is. Cash is certainly king. It's always been one of our mantras in the business. But I think whilst we're generating significant amounts of cash, we're firstly able to invest some of that into the property. We will be, and we have done, we've borrowed some money to help with that property project, but certainly we've invested some of our own cash. We're certainly keen to reinvest in our IT to grow the direct-to-consumer side of the business. I mean, that will help to improve operations and logistics, the sales ordering process, and the general online shopping experience. And that's certainly super important as we move that part of the business forward. We're keen to keep paying a dividend. We've paid a dividend now for the last 11 years. It's been progressive every year, and we're certainly keen to keep that progression going. And also we have a pension scheme deficit, which we're obliged to pay into, and we are paying over £400,000 at the minute into that scheme. So there are a number of uses for our cash, hopefully in the main earnings enhancing, certainly in terms of the project, the property project, which we've talked about, and also our direct consumer business.
No, okay, excellent, thank you. Now, moving on to the current year, you issued an RNS with your AGM statement about 2.5 weeks ago, didn't you, where you were updated us on trading for the first 25 weeks of this financial year, because you have a December year end. So this is the first 25 weeks, and I think the sales were up around 14%, But the really eye-catching number was actually what your forward order book looked like. It was around 35 million, which is almost like a year's worth of your historical sales. It was an extraordinary number. And again, this point last year, that number was only around 10 million. So it's more than 3 times the level of forward order book. So in terms of what's driven this very strong performance that we're enjoying this year to date, has it been just specific areas of the business, or is it more broadly based?
I think it's twofold. There are 2 key areas I would say where we've got a big order book. Firstly, on the FOB side of the business, where our national retailer customers import direct into their warehouses from the Far East. That was more difficult last year through COVID. National retailers were a little more cautious, and certainly this year that has changed. So our FOB business has come back strongly. And I think the second key area is on bicycles. Significant demand for bicycles through the lockdown period. Enormous global demand for particularly bicycle components. And that's really led to our customers placing orders out well into 2022. And to be honest, our ability to satisfy all those orders at the moment is an ongoing challenge. And I think it will be as we go through the rest of the year and into 2022. But certainly at the moment, the order book is strong and it's there.
No, fantastic. And I think one of the features that goes with this almost exceptional demand we're enjoying at the moment, but which you referenced and lots of companies are referencing in the RNS as we read every morning at the moment, is about when you're importing from the Far East. There's seem to be cost inflation coming through. The freight charges are almost extraordinary levels, aren't they? I think with all the ships in the wrong place as we came out of the pandemic. So with that cost inflation and higher freight, are you able to pass on those cost increases reasonably onto your own customers, or is that really difficult?
Yes, I mean it is always difficult. It's with great reluctance that we've had to have gone through several rounds of price increases this year. Trying to put through a price increase on any type of customer, particularly national retailer customers, is very difficult. Nobody wants to pay more for the product that they're buying, but they do recognise the current state of the world, both in terms of input costs and therefore costs of our products, and also, as you quite rightly say, the cost of shipping at the moment is unprecedented. And I think at the moment it's difficult to say when that will reduce. We're certainly approaching the peak season for the toy trade, and historically freight rates do go up at this time of year. So I suspect, unfortunately, freight is here to stay for a few more months yet. And as I say, global demand is very high. Some of the Far East container ports have been overloaded, and Yantian even closed for a period in June. Shipping lines persist with blank sailings of container ships, and we've even had the Malaysian Shimano factory, which was also closed due to COVID for a period. So we are facing a number of challenges, but I have to say we've stepped up to the mark really well. We've got a really strong team across the business to try and make sure we keep getting product coming down through the pipe. And so far, I'm pleased to say that we've done a pretty decent job in the first half of the year. As you said, turnover was 14% up against the comparative, and the order book is very strong. So if we can maintain that momentum for the second half, then I still think we will have a strong year this year.
No, excellent, thank you. And again, that leads me on, really. I think all the things we've talked about so far in the last 20 minutes or so are about a company with a very strong balance sheet, with net cash, freehold property. It's been consistently profitable, and over the last 4 years in particular, the profits have quadrupled. We've got, everything looking very good into this year for that progression to continue. And yet, despite all those things, you could argue that a rating of 8.5 times, and again, I appreciate the shares have re-rated quite significantly from where they were maybe at the start of last year, but nonetheless, even now, only on 8.5 times earnings, given what, you know, those quality metrics we've talked about. Why do you think it is that at the moment the market's not fully recognizing the business and the progress you've made?
Yeah, I mean, I think it's fair to say we've been quite cautious in the past in terms of how we've communicated with the market. I mean, if we go back 20 years, the business was making a loss of £6 million, had an overdraft of 16 million, net liabilities were 5 million, and the past and the present board have obviously worked hard to set in place a strong foundation for us to move forward. So we are now starting to do more and communicate this more to the market. We did an interactive AGM this year, which I think worked well and enabled more questions to be asked by investors. We did a full year presentation, which we did with PI World in April. We had an investor day last September, and recently we've appointed a new broker in Cencos. So I think the foundations are solid now. We're quite excited about the future, and we're making steps, I guess, to tell our story and communicate a little bit more to the market. And I guess hence why I'm here tonight, Alan.
No, absolutely. No, I think as David said, I think David and I have been shareholders in this for a long time, and yeah, certainly up to a couple of years ago, that was more frustrating. We really embrace and welcome the additional communication you're now clearly making a lot of effort to make with us. And that, I suppose, leads on to another question really about broker research, that you're a company who are unusual in the sense there is no research about you in the market at all. So there's no market expectations, and therefore we're having to judge you all the time on historic earnings and all doing our own spreadsheets to try and work out where we think you're heading to this year as well. But do you think there'll come a time as you grow and develop as a business where you'll start to take on broker research, or is it something that's inappropriate for your type of business?
No, in short, yes. We appointed Cencos at the start of this month, and we want to be more proactive in terms of research notes that are put out there, and we intend to put more forecasts into the market. We want to increase the liquidity of our shares and reduce the spread and make it easier for our investors to invest in Tandem. As I said before, I think we've got a good story to tell, and we're telling it right now. No, absolutely. No, that's fantastic. And obviously we've talked a lot about where you've come from, the current strong rise in profits over the last 3 to 4 years, which looks like it's showing no signs of slowing down as we move forward. Looking forward to the next 5 years, how do you see the business growing and developing? Yeah, I think probably there are 3 key areas. I think firstly, the direct consumer aspect of the business is very important to us. There is obviously growing consumer confidence in buying online. I think this has been accelerated by lockdown. And I'd certainly have a really strong personal interest in this area of the group. I see lots of opportunity here. It's tough, and we've got to work hard and invest in it. But I certainly think there's lots of opportunity, and we've started quite strongly and accelerated that over the last year or so. I think no one knows how long the resurgence of bicycles will last for, but certainly since we launched our children's lightweight range Squish, that was in 2017. That's done particularly well. It's steadily grown, and we see a really bright future for that. There's lots of interest in that brand, and there's lots of scope to develop that further as we move forwards. And I think thirdly, the e-mobility part of the market has also got some really strong merits. I think we're cautiously optimistic about e-scooters. Obviously, they are becoming more and more prevalent in this country, and hopefully when the legislation changes to enable them to be legalized on roads and pavements, I think we'll see a step change in demand for e-scooters across the country in a similar way to you see in in continental Europe. So we're excited about e-scooters. We're equally excited about e-bikes. I think e-bikes are growing at a rapid rate, and we started the year with a range of 14 e-bikes, and we've increased this to 22 models, and we're going to continue to increase that through 2022 and 23 because we see the demand there. So I think overall those are probably the three key areas where we see growth in the group, but it has to be backed up by our bedrocks of character licenses, where we've obviously got lots of expertise and experience over the years. So you know, we're not planning to forget about those key areas, as well as our own brands. Our own brands have grown again this year. Headstrong is getting stronger. Kickmaster has been well, certainly benefited from the Euros, although until
today.
yeah, but I think, yeah, we are in quite a strong position. We have a good portfolio of product ranges, and I think that the future at the moment is bright, and hopefully the bumps in the road and the headwinds we're facing in terms of importing and freight and those sort of cost issues are a transient thing, and will pass away over the next few months.
No, absolutely. No, thank you very much indeed, Jim. I think that's really all the main questions that I had. I'd point out to the audience who are interested in Tandem, there's a couple of good sources of information to look for. I think, first of all, Jack Brumby's written a really good piece on Tandem. He's a big fan of it, who, you know, the guy who writes on Stockopedia and often comes onto the Mello Bash. He's written it up, so there's a really good piece on that from about 6 months ago, but really describes the business and why it's a good investment in his view. And actually more recently, when the Stock Slam was on a couple of weeks ago, Andrew Robinson, who's known as Castleford Tiger, he did a really good summary as his pitch for one of his big investments in Tandem. So they're worth checking out. They're available online. So David Streller's going to be delighted with me because I've managed to finish this interview with enough time for questions, which is about the first time I've ever achieved this, due to Jim's very succinct answers, David. So we're happy to take questions, or Jim's happy to take questions.
Do you want me to ask them, Alan, or do you want to open?
Yeah, you please. Yeah, you please.
Okay, well, first one, Jim, from Andrew Robinson, funny enough, you just mentioned him. He says there was approximately £3 million of the finished goods sitting out in the East at the date of the last trading update. Is this now on its way?
Yes, some of it is on its way. Unfortunately, not all of it is on its way. About £2 million is on its way at the moment. We expect to probably ship the rest of it this month or early next. I mean, it is very difficult in some cases getting containers, as we've talked about. And unfortunately, where it's FOB business, this is not something we can really control. It's driven by the relationship that our national retailer customers have with their shipping lines. And we can only push as much as we can to ensure that they sort of take the stock, because obviously it creates a backlog and clogs up the supply chain for more product to come through. But yes, it is moving, and it's something that we're dealing with, well, every single day.
Yeah. Okay, well, Peter asks, do you think there's a possibility of damaging your relationship with smaller businesses by the growth in your D2C business?
Yeah, I mean, we're really very conscious of that fact, and that's why we generally segregate the brands. So we don't intend to sell a number of our independent bike business brands direct to the consumer ourselves. What we would do in that circumstance, and what we're developing, is the ability to purchase online from our websites, but then we would ship that bike to the IBD and they would set it up for the consumer, and then that gives the shop the opportunity to build a relationship and a rapport with that customer, certainly enable them to buy accessories and bring their bike back for a service. So on bicycles, it's certainly not our intention to go direct and cut out the independent dealer, because the independent dealer is the lifeblood of our business, really.
Now, we got over 300 on the webinar at the moment. I know Cliff, who's asking the next question, is a big lover of dividends. He says, you seem to be generating lots of cash. Will this be translated into dividends, or do you foresee a need to raise any funds for acquisitions or maybe other capex?
We don't have any plans at the moment. It's certainly our plan to progressively increase the dividend. Over the last 2 years, there has been quite a step change in the amount of dividend we've paid out, and we're comfortable with that based on the level of profitability that we're generating and the cash generation. So yeah, we're very cognizant of dividends, and it is our intention to keep paying a dividend and keep growing that in a sensible fashion.
Yeah. And you've got an appropriate notice behind you of keep calm and carry on.
I do.
Martin asks, the AGM statement was mixed with lots of buts.
Yeah.
Orders very strong, but delivery is difficult. Costs going through the roof, managing costs well. Delivery is difficult, but we are managing things well.
Mm-hmm.
It looks like you're scared the market. The SP, the share price, has been badly hit, and the market's not so sure. Are you better than competition in managing this situation, as you appear to claim?
Yeah, I think we're very strong in managing this situation. We've been importing for many, many years. As I say, we have a strong base in Hong Kong and the Far East. We have inspectors and QA/QC guys out there all the time, and I think we work very hard to make sure we are better than the competition in terms of importing safe, ethically sourced, and good product. So yeah, I think although there is caution in our announcements, I think it's right to be cautious because there are some headwinds at the moment. But as I said just now, I think they're probably transient, and once we get through them, we're in a good position.
Yeah, and we've lost this question from me, really. You've lost a non-exec director recently. Juliet was only with us a short amount of time. Are you going to be appointing a new non-exec, or maybe even more than one non-exec?
Yeah, I mean, Juliet sold her business. She was the founder of Grenade, and they sold the business for I think it was £200 million to Mondelez. So that she's pursuing other opportunities at the moment, but in a short space of time she did do a very good job, and she did help develop our digital marketing strategy, and absolutely, yes, we are looking to recruit a replacement. We'll do it sensibly, and find the right person to fulfill that role. But in answer to your question, yes, we are. Yeah. Great.
And can you give any sort of update on the ERP project?
Yeah, the specification has been done for that now. We've undertaken a series of workshops for all aspects of the business. We're into the testing phase, and it's still our ambition to go live on the 1st of January next year. And I think once we have that system in place, it will really help, particularly on the logistics side of the business, as we move forward. So yeah, all on track at the moment.
Great. And I suppose an overall question, I mean, I've been a shareholder for, I think, 14 years. You've been there longer than that, Jim. You were FD before you were CEO.
Yeah.
I mean, overall, looking back over, how many years have you been there?
19, David.
19.
Yeah.
So in 19 years, can you ever remember a time when Tandem looked in better shape and had better opportunities?
No, I think we are in very good shape at the moment. We've got a number of strings to our bow. We've got some strong licenses, and we've talked about the B2C side developing. Bicycles are strong. So yeah, I think at the moment things are going well. We're making money. We're generating cash, and I think we're moving forward at a decent pace now.
Great. Well, it's been a long time getting you on the show, but it's been worth the wait, Jim. So thank you to Alan, and thank you for you coming along and explaining how the company's doing. And I think it's great for people to get to hear straight from you. And we can do lots on the show, but you can't beat getting the CEO on to answer the questions. And You've been very good at doing that. So thank you, Jim.
That's superb.
Great. Thank you very much.
Best
Thank you
wishes
very
for
much.
getting
Thank you,
all
Jim.
the
Thank you,
things
everyone.
into the right place. So good luck.
Brilliant. Thank you.
Thank
Cheerio.
you.
Bye.
Bye. Okay, well, now we have another company presentation, and we got Martin with us and Dan as well. Great. So the next company is Emotion, and I think, Martin, I remember quite a long while ago, I was involved in another company, but that's a long, long way back. You're now into a new company. You're quite well known in the space that you're in. So you're going to tell us all about Emotion.
Yeah, thanks, David. I'll put some slides up on the screen, which hopefully will help me if nobody else. So let me just get those to the beginning, which obviously helps. So can you all see that?
Yeah, it's coming up, I think. Just give it a moment. Bit of a delay.
Tell me when you're on, David, and then we'll...
Nothing yet.
It's showing at my end, so...
Ah.
Let me just do it again, David. Just give me one. The wonders of technology.
There you go. There
Okay.
you go.
There you go. Never do live
That's good.
demonstrations.
Great.
So I just thought it'd be helpful, maybe just to sort of give an overview of Emotion for those that don't know the business or how we evolved. When we set the business up, it was really very much a focus on immersive sort of entertainment. And that was predominantly driven through location-based sites, which I'll talk about a little bit later on. Obviously, last year when the pandemic hit, we really had to sort of start rethinking. We went from a business that was on the brink of moving to great things to sort of almost most of our sites being closed. So we rolled up our sleeves and introduced two new businesses, one being home-based entertainment and Ubisoft, both of which I'll talk about a little bit later. But I think it's real testament to the team that I was with an investor recently, and he said that of the businesses that he didn't think would make it, we were in his top one. So I think it hopefully shows some testament to the team, to our ingenuity, to our entrepreneurialism, and really, what you have to do to sort of survive in a crisis. So just sort of dealing firstly really with a bit of background and the sort of current trading. Obviously we listed on AIM in 2018-19, and it was really about building on those foundations. It was about getting into this sort of immersive space and really looking at partners such as MGM and Merlin that we could partner with to put our operations in place. In April 2020, we had break even in sight. Everything was going really, really well. We'd just done a big install at MGM in Las Vegas. And all of a sudden the pandemic hit, and it was about survival more than anything else. As we move into 2021, we are starting to see really strong recovery. It's bounced back, probably in line with what we hoped, in some ways probably better than we could have hoped. Record revenues in sort of April, May and June, and I think July will be equally another record month. Moving into EBITDA in May, June cracking month, July will be great. We're moving into summer, so we think there's plentiful sort of growth opportunities in front of us. And as we look at just to give you sort of some background on why did we get involved in location-based sites, what we really wanted to look for were sites that had already high footfall. So when we looked at aquariums and zoos as a good example, their footfall was pretty constant throughout the years. And therefore we felt if we could deliver something that sat alongside their existing sort of operations, then we could benefit from their footfall. We could also give them something that was sort of slightly different, bring some technology into their faculties. And in doing that and in creating our sort of immersive experiences, we really found something that really enhanced their operations, but was perfect for what we wanted to do. So very much focused on the edutainment. It was about a recurring revenue. The good thing with aquariums and zoos is you don't have the same customer coming back over and over. So you've got lots and lots of churn with the customer base. So we knew that we could put something in, we could run the same sort of program, the same VR movies in there, and obviously get great revenues from those VR movies, because people were seeing them once and they may come back the next year, but often that's a new set of kids coming on board or a new family or whatever. And our whole sort of modus operandi was really about getting quick payback. So we wanted to originate our own content. So if we look at the content that we originated originally for aquariums, we went and filmed things like diving with whales in Tonga. So we found a free diver that could hold his breath for 4 or 5 minutes, could then hold a VR camera whilst holding his breath, and we could go and film the humpback whales with their calves. And that meant with some proprietary content, we did exactly the same with sharks, and we created a number of sort of CGI movies as well. So all the content was proprietary. And then it was about sweating that asset across multiple sites. And obviously, the more we can sweat the origination of that content across sites, then the higher our margins. And what is important is no one site could afford to do this themselves. So we had something that we were sort of well protected in what we were doing in terms of our business offering. So very attractive payback, a real win-win in terms of our partners. We were putting in something that enhanced their faculty, that they couldn't afford themselves, and we were then sharing the revenue 50-50, so with a very swift payback. Normally sort of 6 months is what we look for. So just how did we evolve the location-based operations? Well, first of all, we started with sort of small sort of ancillary offering, and it was really just sort of 2 seats that we could put into some of the sea life centres with Merlin. And as time marched on, that increased to 8 seats. And now, as we sit here today, and this was certainly the case last year, and the pictures that you see there are our installation at Mandalay Bay in Las Vegas. So we moved to large installations, so giant sort of VR theatres, sort of mini cinemas, with a pre-show area. So you'll see in the top photo, the top image there, that's our pre-show area. So it's got details of sort of the sounds of humpback whales. There's a little sort of shark selfie, so you can go and take a picture of yourself in a shark cage. And then all of that really enhances the queuing process. So in enhancing the queuing process, we can charge more. So for that particular operation, we charge $10, and we share that 50-50 with MGM. And that site is doing amazingly well. It's back up and running at full capacity now. And the numbers are really encouraging from that one site, as are all our sites. So just in terms of what does a partner offer? Well, the partner offers the space, and obviously they offer the footfall as well. So we're looking for partners with solid footfall. Mandalay Bay has a lot of footfall, several 100,000 customers per year. We offer the hardware, the software, and what we've also developed, a piece of proprietary technology, is that we can operate multiple motion platform seats, all from one tablet. So we've actually managed to develop this, so it allows us to, or allows them, because they provide the staff, to operate the theatre with minimal staff. So the picture that you see there can operate with 1 to 2 members of staff at peak times. And that particular site will generate, well over probably $100,000 a week, just to sort of give people some idea of the revenues. We provide the CapEx, but again, because we're making the movies once and then sharing them with multiple sites, the more sites we add on, then the lower our sort of CapEx is. And we've managed to really squeeze the cost out of the motion platform seats. So originally, when we looked at the first picture that you saw on the previous slide, each motion platform effectively had 3 computers in it. And because we've developed this piece of proprietary technology, now we're just down to 1 computer per motion platform seat. So the seats are coming in round about sort of £2,500 to £3,000 a seat, to give people some idea of the cost. So they're not massively expensive, but when all linked together and all sort of, this cumulative offering, it really does look an amazing, immersive sort of piece of entertainment for the user. So just to give you some example of a 24-seat installation and how that would sort of work out. So if we base this on, and this is just an illustration to give your viewers some idea of how the numbers work. So if we looked at 24 seats with 700,000 footfall, and as I said earlier on, the footfall in these sites is constant. You can look pretty much back for the 5 years and it will be, within 5% normally. So it's very solid. We look for sort of around about sort of 15% conversion. Some sites are performing better. We haven't got many performing worse. So average price per cycle in this example, we've used £5 excluding VAT, revenue share at 50-50. That would give us a gross revenue from one side of 525,000, 263,000 to us. And with payback for that would probably be about 7 months, to give you some idea. And most contracts that we enter into are 3-year contracts. And as we become an integral part of the faculty, one of the reasons I'm very keen on doing bigger theatres and pre-show and really making it sort of, as I said, an integral part of the faculty, is we become part of the fabrication. And the more we become part of the fabrication and the more we become sort of something that's the norm for the staff, then I think the longer we can expect those contractors to continue on. So where are we today in terms of number of headsets that we've got out in the field? Well, we've got 43 sites, 350 headsets. Predominantly, we're sort of seeing most of those in the US, and our focus over the next 6 months is going to be to drive more and more from the US. We've got a US operation. Our sort of group commercial director is based in LA. We see the US as a great market. We think it's very resistant, as is the UK, as we come out of the sort of the pandemic. So our focus is on those, as I said, focus mainly on the US, but with some UK. The other good thing with the US is that when you see a price on the sort of the retail price that you pay, it's obviously that's net of sort of taxes and local taxes. So whereas in the UK, there's an expectation that the price that you pay includes taxes. So we actually see a sort of 20% benefit really by being in the USA. So $10 is what we charge for the site in MGM in Mandalay Bay. So as I touched on earlier, when the pandemic hit, we really were sort of scratching our head as to how long is this going to last? What are we going to do? And I think at that time, nobody really knew what the future held. So we decided to use a lot of the assets that we already owned in terms of the content that we produced to quickly produce a home-based product. And the product you see in the two photographs is something that we managed to create from scratch. We sourced the headset, we designed the headset, we designed the cube, the sort of holographic cube. We did the box, we wrote and produced a book, and we did all of this in 12 weeks and actually got it to market in late September, early October of 2020. We sold 11,000 units, generating revenue of £600,000. So it was a very welcomed piece of revenue for us. Now, what did we learn through this period? Well, we learned that there was definitely demand for VR at home. By actually packaging the headset and the content together, we, for the first time, gave the consumer something that was bundled. And I think the big challenge with VR at home is lots of people sell headsets, lots of people sell content, but nobody actually sort of merges the two things together. So we did this in a very sort of cost-effective way and packaged it all around aquariums. So we did Let's Explore Oceans. And as we look out to the future, first of all, it was about getting our e-commerce sort of foundations in place. So now we've got relationships with Amazon, we've got those in the UK and in the USA and Canada. We've got good relationships with Facebook and with Google. We've launched into the USA and Canada in sort of H2 of this year. We've got local fulfillments there. We also have a fulfillment center in China, so we can fulfill Asia Pacific. So Australia, we can now fulfill directly from China. So much, much cheaper. And it also means, as he was saying on the guy from Tandem, saying, shipping costs are horrendous. So if we can keep those actually just shipped direct from China into Australia and Singapore and so on and so forth, it actually reduces our cost of goods. And what we've also been able to do this year, because we're not, we weren't sort of not as rushed, we've been able to plan our Q4 season. So we've managed to forward order stock, significantly reducing the cost of goods, therefore improving margin. So we're really focused on Q4 and also, quietly working in the background on developing sort of other products and other sort of pieces of content for the Let's Explore series. But our main focus this year is twofold. One, it's in our location-based entertainment. You've got to remember that most of this stuff has been mothballed for the best part of 14 months. So we're bringing it out of mothball. We've got to make sure that it's fully operational. We've got to make sure that we maximize the revenue from every single location site that we've got. And we're seeing that. You saw that in the figures in March, April, May, and June. And I think shareholders will see that as we go into the summer period in July and August, that the focus in on our location-based site will really pay dividends. As we move on to the home-based entertainment, it's about focusing very much on that Q4 period and making sure that we're fully equipped, both in the UK, USA, Canada, and Australia and Singapore for the Q4 sort of buying period. Intent is much, much higher in that period. So therefore our cost of acquisition of users is much lower, and therefore our margins are much greater. So very much a focus on that period. And then I think the other accidental hero that came out of the pandemic was Uvisan. One of the challenges that we had with our partners was that they were looking for us to deliver them a solution that could guarantee that headsets that people were wearing were fully sanitized. And you can see all the reasons for that, and we had to develop something very quickly. So again, we managed to design and build these cabinets within probably about 8-9 weeks. An amazing team effort. The cabinet that you see on your right-hand side is fully tested. It's now CE certified. And then they've also gone on to develop a thing called Clean Room, which effectively disinfects an entire room using the controllers that are photographed there on the right. And that is a piece of proprietary tech that we've developed in-house. So what we've managed to do with this business, and as I said, very much an accidental hero, is create something where there is demand. We have started selling these into companies out with the sort of VR industry. And albeit that we've got sort of endorsement from HP and endorsement from Microsoft, we've actually started selling these into recording studios, into TV production studios. Some of you will recently have seen our sale into Aardman, which they took it so that they could continue to film sort of the Shaun the Sheep movie. And we've also now started selling into hospitals and schools and other sites. So we're seeing big uptake with this. And I think what people will see over the sort of coming weeks is a growing distributor network. We're getting lots and lots of inbound inquiries to resell this product on a global basis. So it's something that we're very keen to look at, is how do we take this and how do we sort of expand it? It's something that we need for our VR business, but it's something that I think we can definitely generate cash from. And cash is very, very important to us. So to have that sort of additional inflow of contribution is very, very welcomed. So then looking at what are the sort of key takeaway conclusions from our business, I think we're very much in an area of vast sort of growth and opportunity. We know that the amount of aquariums, and now as we move into the zoo market, want technology. They want our immersive experiences. The whole immersive theatre, along with pre-show that we're now offering, is in great demand. I don't think we've ever had so many inbound inquiries. It's about being very selective with those inbound inquiries, making sure that we do all the due diligence, make sure that we check their footfall figures, making sure that their promotions and everything are linked in with it. Sites like Clearwater, which we recently did in Florida, again, delivering record revenues. So we need more of those sort of sites. And, you know, we're actively in conversation with a number of big aquariums and zoos about putting those in. And there will be much bigger experiences than people have seen historically, because that's, you know, as the business matures, it takes as much effort to do a big site as it does to do a small site. And I also think we're maturing as a business in terms of what we're offering. The whole pre-show experience, the VR theatre, the ability to be able to operate up to sort of 60, 70 seats from one terminal is a very compelling offer. We've had a great recovery from COVID. And I think we're, you know, in some ways we're lucky. And I think a lot of it now is going to be by design. But to have the majority of our operations in the US and the UK has really served us well. Obviously, vaccinations in those territories are very high. So I think that's been, as I said, something that we're very grateful for. We're now into profitability, and we see that just enhancing. You know, one of the things that you know, you were talking about earlier was this whole sort of tipping point with AIM businesses, and I think we're very much at that tipping point now. You know, we've gone into profitability, we've gone past the costs base, we've covered all of that, and every site that we now add will flow straight to the bottom right-hand corner. And I think that is a really important thing as we move forward. So we're seeing a very strong H2. You know, we're expecting some great things. We think there's huge growth opportunities as we look forward over the next 6 to 12 months. So we're well positioned. As I said, it's, you know, we've got cash in the business, we're generating cash, we've got stock of emotion platform seats, we've got stock of sort of headsets for the Let's Explore business, and we've got stock of Uvisan. So we're really well positioned to take advantage of the coming months. So hopefully that's given you a little bit of an insight into emotion, and hopefully there's some questions that people may want to ask about the business.
Great. Well, thank you very much for that, Martin and Dan. We've got lots and lots of questions for you, so I'll go straight into them. Vivek says, first time I have come across you, so apologies if this is a silly question, but if you cover the CapEx installation but are reliant on the venue owner to be able to monetize the hardware, stroke, software and content, does this not give a lot of power to the venue owner operator, especially as agreements come up for renewal? Presumably, if it doesn't add value to them, they would return the equipment. So what happens to the equipment? Can it be resold or repurposed?
Well, first of all, thanks, David. And there's no such thing as a silly question. So, so I think let's deal with that in a number of sort of parts, if we may. First of all, what we try and do is we try and provide our partners with a fully integrated solution. So we vet our partners very carefully. What we want are partners that want to work with us. Most partners cannot afford to put in something that is so high tech and immersive as we would offer. So what we really want to do, whilst the agreements are sort of 3 years, we're trying to look for something that is a start of a long-term relationship. Now, as we put these products in, and yes, all the equipment can be taken out and reused. So, you know, the motion platforms can be taken out and reused. Obviously, the content sits there, and we can use that anywhere we want. So, the main thing is we're looking for payback of our hardware in around about sort of 6 to 7 months. So, whilst it can be reused, what we're looking at is something that, as I said, is a quick payback and is enhancing to the faculty itself. Now, if we've done our job correctly, and I think we are doing it correctly, and the numbers and the growth in the numbers in terms of revenue, I think proves what we're doing, and we're doing it right. And the number of inbound inquiries, I think, proves we're doing it right. As I said at the start, most zoos and aquariums cannot afford to do this and haven't got the technology or the knowledge to do what we actually offer. So I think it's a great enhancement, and for many, they're now using it as a way of further promoting their zoos or aquariums.
Great. And David Whitehouse asks, do the VR sets work well for glasses wearers, long and short sight?
Yeah, I mean, well, the headsets that we use in our location-based operations, yes, we haven't had any issues. We were very cognizant of glasses wearers, so we test these things. When we did our home-based solution, we actually developed the headset that had sort of little focuses on the top, so you can actually sort of tweak those to suit. So we haven't had any issues with glasses wearers. We have a lot of glasses wearers on our board, so we test these things rigorously. So far, so good. You know, obviously there will be the occasional case, but you know, to date we've had no objections.
Okay, and Peter asks, home-based entertainment needs considerable ongoing, maybe expensive content development to be sustainable, yet still affordable when providing at least a couple of VR experiences per pack. The cost to buy extra experience can't be too high either, say maybe £15. So this looks like a business you need a big commercial partner with rather than for you to develop.
I think it's a very good question, and it's something that we've thought long and hard about. So you have to remember the home-based entertainment division came about with content that we had already in our arsenal. Now, out there at the moment, there are lots and lots of VR content producers producing amazing quality VR, but with no home. So our aim is to really get more and more users on our base, and then to start offering third-party content, sharing that revenue of the sale of that content with the producer. So I think we have a very clear plan of how to do that. I think you're absolutely right in that the cost of content origination is very high. So yes, we've got some hero pieces, but I think there's also lots and lots of content producers out there. So what we need to move on, as we develop our home-based entertainment solution, is to develop that as being almost content and hardware agnostic, and it's more about retaining that customer. So we've got some exciting plans. We're slowly working on it, but it's not about spending tons of cash generating new content, and that's for certain.
Yeah. Sam asks, in November 2020, in the placing, you said cash and management time would not be focused on New Vision. Since then, New Vision seems a focus again. Please, could you explain, and what is the balance between being entrepreneurial and being strategic?
Well, I think we are still strategic. We're still very much focused on our core mission, which is delivering immersive entertainment. We need to deliver solutions to our partners. So the fact that we can just order more and sell these to third parties, I think is good. And as I said it earlier on, what we really want to look for is distributors and resellers. Therefore, people who are just placing regular orders for the content, for the products that we have originated. So we don't envisage taking management time going forward. We don't envisage it taking a lot of our strategic time. It was an accidental hero. It's something that generates a welcome contribution. But I think the more we can, as I said, offset that to distributors and resellers, the better as we move forward.
Yeah. How will you finance new big experiences? Your appeal is you take the capital costs on. More equity finance, maybe debt finance. How much does financing limit your growth trajectory?
Well, at the moment we've got motion platforms in stock. We've got cash. I think as we're now generating cash as well, it becomes how quickly do you want to grow versus the cash that you have in the tin. I think we reserve the opportunity to talk to debt providers. Obviously, as we now have moved into profitability, then those conversations can be reignited. We are very, very fast payback. So the return on capital is very, very good. So I don't see any problem in actually the business taking on debt. paying that back very quickly and offering a very good return for shareholders at the same time.
Great. Now, Chris asks, at present, there are no forecasts in the market. When do you envisage guidance being re-established?
Yeah, look, when COVID hit, I think it was wrong to continue trying to forecast when you were treading through treacle. And what we've said is that we will look to reinstate forecasting and coverage by the end of this year. What we really wanted to see is a sort of firm line in the sand as to COVID being behind us. And we're starting to sort of see that now. But I think it would have been remiss for us over the last few weeks to do something. We've had a number of stop-starts, and there's nothing worse than putting a forecast out and having to change it due to sort of COVID-related restrictions.
Okay. And Donor O'Brien says, what is the competition in this space? What gives your product a competitive advantage? And what USP, I guess, do you have?
Yeah, look, there are lots of moving parts in what we do. And yeah, I think we've got a good advantage in terms of the content that we've produced ourselves. We have worked out how to sort of get all the motion platforms operating from one terminal. And I think pulling all of this together in a sort of rather complicated marketplace gives us a distinct advantage. Does it give us something unique? Probably not. Does it give us a very good head start? I think definitely. And I think what we're about moving fast and securing that market as quickly as we can.
Yeah. Martin asks, how big do you think the market could be? What's the demand from aquariums and zoos, for example?
Well, we haven't really touched zoos at all at the moment. So, you know, we're looking at zoos, and we will have a zoo product for early next year. So the aquarium market, again, we're just touching the sort of tip of the iceberg. And with the bigger aquariums, I think there's a number of those that we can get. You know, things like, as I touched on before, Mandalay Bay is a decent size aquarium, but that site alone, you know, will generate, you know, probably $100,000 a week of sort of revenue. So you can get some idea of the opportunity. And what we need to do is look for more aquariums. The zoo market is much, much bigger than the aquarium market by, you know, several fold bigger. And I think the zoo market, like the aquarium market, has just been through the most torrid 18 months of their history. You know, you can't furlough animals; they still need to be fed. You can't really furlough the keepers, so they've all hemorrhaged cash like never before. So the demand for a product that is got no capex and generates cash from the get-go is very, very high.
Yeah. And Anthony asks, does having a setup in, say, Mandalay Bay prevent you offering the same service at other locations in Las Vegas?
It would certainly, we wouldn't want to offer another aquatic service, but one of the things that we have developed and we have running at the O2 in London as an example is our sort of tower coaster. So we've created this tower coaster where you can look at over the city of London from a sort of VR coaster perspective. So, you know, it wouldn't be beyond the realms of possibility to maybe sort of see something similar to that in Las Vegas or New York or other cities around the world.
Yeah. And Dave Royal asks, bearing in mind animal welfare issues, do zoos and aquariums have a long-term future?
Well, I think that's a really interesting question, and I think it plays to what we're doing to a greater or lesser extent. You know, if you look at it long term, I think the pressure on zoos and aquariums is definitely going to be there. But what we actually offer is almost a sort of digital aquarium. We offer you the ability to see whales with their calves very, very close proximity in VR without ever sort of having to have these in captivity. And we do exactly the same with sharks. And what we can do with the benefit of things like sort of computer generated graphics is we can actually give you extinct species or endangered species, and we can send cameramen to the far-flung places of the earth where we can film in VR, and we can give you an experience that you could never replicate in the zoo or the aquarium. So I think in many ways, the pressure that is going to come on zoos and aquariums will actually just enhance our position as we move forward, because I think there is the interest in the natural world is probably at an all-time high, but yet there is this sort of resistance to animals in captivity. So people want to see them, and I think virtual reality and immersive reality, and you've got to remember that technology will keep improving. So the more technology improves and the more you then get mixed reality coming into this, we will be able to offer something that people haven't even imagined yet in 5-10 years time, and it will be the zoo of the future. So I think the aim that we have really is to work collaboratively with our partners. As they get pressure for keeping animals in captivity, we can start replacing them with sort of, you know, an immersive solution.
Great. And Vivek wants to know, for costs related to repair and maintenance of the hardware, who bears the risk of this, and how much is maintenance capex approximately?
Well, because we managed to sort of strip out most of the computers from the motion platforms, then the only computer that we have operating 60, 70 seats motion platforms is a tablet. So if that breaks, then we all know the cost of tablets, and it doesn't have to be an iPad, an Apple tablet. It can be a cheaper tablet, so it's not very much. What we then have is we have what are called Pico headsets. So the computers for the VR actually sit within the headset. And those headsets are about €400 each. And each headset comes with a 3-year warranty. And we're writing them off for a much faster period than that. The motion platform seats themselves, we've had a number of in operation for 5 years plus, and they've gone through rigorous testing. Now, motion platforms themselves are fairly robust pieces of kit. So we think that's probably got a sort of 6 to 10 year lifespan in reality. We're writing it down much quicker than that. The headsets we will replace on a regular basis, but they're €400 a piece with a 3-year guarantee. And the tablets are replaceable, you know, as you need to replace them, really. So in terms of, you know, costs, it's not very much. Everything that we do is we can look at any of our sites remotely, so we can fix any computer problems through the cloud anyway.
Great. Well, you've done really well, Martin. I'm glad you saved plenty of time for the questions, and you got through just about all of them. So one last one now. Clearly, you've got lots going on and lots of opportunity. Do you envisage any further fundraisers this year?
No.
Well, that was a quick answer, so that's good. Excellent. Okay. Well, I'm sure the investors have learned a lot, and we've still got over 300 on the webinar. So well done for getting through everything. And thank you very much for joining us on Mello Monday.
Thank you.
Thank you.
Thank you very much.
Great. Well, there we go. That was our final company presentation. Now we've got the bash. I know you all enjoy the bash, and I know you certainly enjoy having Paul and Kevin on it. So there you go. You're both on mute, guys, but
yes, hello, David. Hello, Kevin.
there we go.
At home.
Oh, look at that, Paul. You're surrounded. You've got Maggie and the Queen.
Oh, yeah, that was random, completely random, actually. But
I'd love to say you're wingmen, but it wouldn't quite be the right term, would it?
I can tell you've been watching the tennis, David. You've caught the sun very well.
Oh, I know. Well, watching and playing. I had a fair bit playing yesterday. I wanted to get it out of the system. Yeah, excellent.
Good stuff. Good stuff.
And you're well? You're keeping well?
Good.
Good.
Yeah.
How's Kevin? We haven't seen Kevin for quite a while, but
I've been very busy. Still am very busy.
Oh, well, thank you for joining us. So we're going to cover maybe 2 or 3 companies today, but the one thing I wanted to maybe cover first is with Paul, because I know, Paul, you're covering so many companies on your small cap report, but of course quite a few of the attendees on these webinars maybe don't get the Stockopedia service that you provide, or certainly maybe only half of them. So How about giving us a brief roundup of some of the highlights of the last 3 weeks while we haven't been on air?
Yeah, okay. Let's see if I can do screen share. I know I had a problem with it last time. Here we are. I've got these The nice thing about doing a quick run through of the small cap reports is it's just reviewing work me and Jack have already done. So we write these reports every day on stockopedia.com. It's behind the membership firewall these days. Not firewall, what do you call it? Fee wall or whatever.
Paywall.
Paywall, that's it. Yeah, it was free for many years, so they're charging for it now. So apologies to anyone who doesn't subscribe. But so this is the landing page for the small cap value reports. Those are rather old photos of me and Jack. So I thought I'd quickly run through. Well, David, you asked me to run through the last 3 weeks, so we'll be here until midnight. So I've just picked one stock from each day.
Yeah, pick your highlights.
It is the sort of standout stock on each report. So hopefully these are in the right order. So Monday, 21st of June. So we put the tickers at the top. I'm only going to cover the stocks that I've written about because I don't want to put words in Jack's mouth. So the first one on 21st of June is Smith's News. Now, you should bear in mind I hold probably about half of the shares that we're going to talk about in this section. So I am talking my own book, but I don't have any intention of selling any of them. They're long-term holds. So I think it's only a problem when people talk up their own book if they're actually intending or selling at the same time. That's crossing a line, which is not something I do. So typical, isn't it? It's not coming up. Well, anyway, Smith's News, the number one, this is a value share. Yeah, here we are. You've got, let me just minimize this so I can see the data. Okay, you've got, I can't see it, but you've got here, sorry, I self-feel, I can't do it. Anyway, you've got basically a very low forward PE. That's the main attraction of this share. That is based on accurate broker assumptions. You've also got dividends resuming. They've just reintroduced a dividend. Now, the interesting thing is the net debt is nowhere near that high. Take enterprise value and market cap off each other, implies about 100 million because there are 2 large receipts due in, which should reduce that significantly. And net debt should be about 1 times EBITDA within about 6 months, at which level they're going to pay out pretty much all the cash flows as dividends. So this one, if you drill into the numbers, should be a very, very generous dividend payer over the next couple of years. The downside with it, as you would expect for a stock on a forward P of 4, is that you've got a structurally declining business, which distributes newspapers and magazines. But because the cover prices are going up, that offsets a lot of the volume falls, and most of their costs are variable. So I have sort of taken that into account. So I think it might be of interest to value investors. So none of these are recommendations. I'm just flagging up things that I think are interesting. Okay, that's the first one. The next day is covered. Is 22nd of June. Now the stock I've picked from this day is Gear for Music, which again I hold this one. Sparkling. We put a little summary at the top here, and then there's a lot more detail below in each report. So basically, they published absolutely stellar results for financial year March 2021, but that was obviously helped by lockdown. Gear for Music sells musical instruments at relatively low prices, online only, and it's just structurally growing from taking over from physical retailers, and also it's slowly displacing the market leader, which is a German company called Thomann. Very, very interesting company. Forecasts, simultaneously the results, forecasts for the current year were increased by 50%. Sorry, I failed to press that. This is the trouble, asking a man to do 2 things at once doesn't work. Forecasts were up by 50%, and then the broker forecasts were showing an absolutely massive drop in earnings for the current year, which looked way overdone to me. And sure enough, it turns out that more of the growth was structural than due to lockdown already, and I think it's set up for more upgrades. As you can probably see, I don't know if it's come up for the PE ratio. It's not particularly cheap. It's a growth company, but I think that there's an opportunity here because the broker forecast should considerably increase. And just to give you a flavour for that, if you scroll down the stock report, this is the standard page you get for every share. See that analyst consensus graph. Shows you that this is a really useful little graph, shows you the movement in earnings per share forecasts for the current year and the next year. As you can see, they've gone up a lot recently, from 20p to about 30p, and I think there's upside on that as well. Okay, moving on to the next day, which is the 23rd of June. For this day, we covered quite a lot of stocks there. As you can see, 6 of them. I think there are 2 I just want to highlight here. Jules, again, I also hold this one. I'm really keen on this as a long-term investment. I think it's just quite a lot of these are things I just want to hold forever, really, unless something goes wrong. Now this one, again, the broker forecasts have drastically increased. I think it's Libram have put through a huge increase in forecasts because it's now, it's obviously a fashion retailer, but it does most of its sales online. So they managed to offset the physical lost sales in lockdown and replace them with online sales, so they remain profitable. So the stores have now reopened and they're doing well. So they put out a slightly ahead of trading, slightly ahead of expectations trading update. But this, again, look at the forecast growth on this little table further down, and you see, can you see that? I can't see it on my screen, but that, you know, shows the scale of the opportunity. I think this thing's going to be a hell of a lot more profitable than people think. Then also on this day, I would flag Virtue Motors, and in fact, there've been a number of car dealers reporting lately. As you can see here, this is the summary. Again, big profit upgrades. Again, I think that was from Libram as well. And astonishingly cheap, I've put here on a P of about 8. And it's fully asset backed with freehold property. So that's why that one's my favorite value car dealers. But I would say we've also had positive updates from Pendragon, Marshall Motors, and Lookers. So all the car dealers are trading their socks off at the moment, even though there are supply difficulties coming in the second half because of semiconductor shortages. Paradoxically, that actually increases their margins because second-hand car prices are going up. So supply difficulties may not necessarily be a problem. Right, Thursday. Oh, Kevin, do you want to chip in on any of these? Just sort of.
No, not at all. I agree with the first 3 hours. I'm long of myself.
Oh, good, great stuff.
Virtue, I'm not long of Virtue, but I've got a big position in Marshall Motors.
Yeah, they're very similar, aren't they? Similar investing case, similar valuation.
Yeah, Marshall Motors is a little less liquid. So.
Okay. Yeah.
But you pay your money, you take your choices.
They're very similar, aren't they? I wouldn't be surprised if there's consolidation in that sector, actually, from private equity, maybe doing a sort of roll up. I don't know. Okay, Thursday, 24th of June. You'll like this one, David. Tandem cropped up. I think Jack did that report that day. It might have been when I had an unplanned outage of me, not the internet. Now, I noticed there's been, I thought the presentation from the company was really, really good. I know you've battled long and hard to draw the company into, and well done to the company for being receptive to wanting to engage with private investors, whereas they were quite hostile in the past, 2 or 3 years ago, I think, for the former chairman. But it's great to see a turnaround in attitudes there. I like the company. I thought the presentation was great, by the way, today. And I noticed it's succumbed to profit taking recently. So I think that's something I might look at revisiting myself as and when any funds are available. I think if they can crack any of these direct-to-consumer website things and start to get a re-rating as a e-commerce growth business, that could be transformative from a market cap of only 28 million. Yeah. So any thoughts on that one?
Yeah, I mean, for many years, you know, when we asked about the websites, they said, oh, we don't want to compete with our, you know, main customers. And so they stayed away from it. I think now they're realizing you can do both. You can't, you know, as long as you're sensible about it, you can supply both. And
I liked his point about segregating the products as well. Some that are e-commerce only and some are for distributors.
Exactly. Yeah.
Seemed a good idea. Okay, and the last one for that week was the 25th of June. That was lucky. So the one loads of companies covered on that day. The one I'm just going to flag is UPGS. That company's done tremendously well. Up Global Sourcing, I think, is their name. They bought the Salter brand. They already had parts of it under license. And I just crunched the numbers further down on the report of that deal and came to the conclusion it looked a very good deal. Enterprise value EBITDA ratio 7.4 to buy a valuable brand with high margins, and it also neutralized a license fee that they're paying for use of the brand, which is factored into that valuation. I think, you know, I'm increasingly impressed with management there. It seemed to be running a really nice business. Not one I hold personally. I think I've missed the boat on it, but it looks a very, very good company, I think. Okay, following week then, 28th of June, the standout one for me there was Cambridge Cognition, COG. This has been a really nice winner in my portfolio over the last year or so. What I spotted there was that, and flagged up to the readers over the last year in these reports, is that the order book was growing really, really strongly. They ended 2020 with an order book that was doubled, and nearly all of 2021 revenue was contractually in the bag with signed contracts at the start of 2021. Something's clearly changed there. They had it's a turnaround under a new CEO who's been there 2 years now, and he's really just made what was a really good scientific research company into now a much more commercially focused organization, and the contract wins are just coming thick and fast. And each contract that comes through is 80% gross margin on a largely fixed cost base. So I think the operational gearing there is very nice. The only thing is obviously the shares have gone up a lot, so you've always got to keep an eye on the valuation and say, well, has it run ahead of itself? Time will tell on that. I don't know. I mean, I feel the market cap, I think, is only just over 50 million or 55 million. It's now profitable on a run rate. 56 million. Downside risks are that it has been a serial disappointer in the past. There have been a couple of false dawns under previous management. So we can't rule out the fact that that might be the case this time again, although the order book's never been anywhere near this high. So I think I'm reasonably comfortable that's not the case. It's always difficult, isn't it, when a share price has done this? You know, do you top slice? Do you hold? Do you buy more? Difficult decision. Everyone's just got to make their own mind up. Tuesday, I looked at, is that the same report? Sorry, yeah, these are not labelled, so I'm guessing each time which one will. Right, the next Tuesday, 29th, this is the last week Tuesday. The one I want to focus on is ELTA, ELTA, which is Electra Private Equity. I've covered this extensively in the small cap reports. It's up 50% since I first mentioned it in March or April this year. I think it's got more upside. It's only got two investments, Hotter Shoes and TGI Fridays UK restaurants. If you look at the valuation of both of those, you know, consolidated and take into account debt and so on, I think it's still cheap. It's about £6 a share. I think it could be £8 up to £12 once it's divested the two remaining investments, which are going to become separately floated companies in September, later this year. The first one is anyway. And then the rump of the business, ELTA, is going to become Hotter Shoes, will be renamed. I think they're both really good, highly profitable businesses, and this is a cheap way into those shares, I think. Over to you guys. Any comments on any of those? You're on mute, Dave.
I can't disagree with anything you've said so far.
Yeah, well, yeah. I'm
Wow.
the same as Ken. You do such a good job of covering them, Paul. There's not much we can add.
Oh, well, I'm conscious of time, so I'll try and finish the. Have we got enough time to carry on, David? Or?
Yeah, another 5 minutes. Go.
Another 5 minutes. Okay, very, very quick then. Wednesday last week, I've picked up on Studio Retail. Now, this one, really, really good results. Encouraging outlook. PE of 6.6 for an e-commerce business that does high cost, high default lending as well. So it's a bit like N Brown in that regard, but it seems to be firing on all cylinders. I think this is really, really cheap. I don't understand why the PE is that low. So again, another interesting one for people maybe to have a look at. None of these recommendations are just my personal views. And obviously everyone needs to do their own research. Lookers published their late accounts on Thursday, 1st of July. The shares have done amazingly well because it was almost priced to go bust when the shares were previously suspended. I think it's probably caught up with the rest of the sector now. So that's another car dealers that looks good value. Right, Friday last week. Yep. The one I picked for this one is actually a new float called CMO Stores. I wrote quite a skeptical piece about it in this report, but mainly because I like to almost play devil's advocate and look for the downsides, because all the stuff that's put out to the city is obviously pumping the story up. And actually, on reflection, I think this is quite interesting. It's a online only builders merchant, which is looking to disrupt what has been quite sluggish uptake of internet. It's got 7 websites doing various products, and it drop ships the products, so it doesn't need to hold much inventories. I think that's potentially interesting, so it's just to flag it to viewers. They might like to have a look at that. Monday this week, I'll flag up Interseed. This is another one that's done very well for me, IGP. I've held it about 3 years now. The turnaround under the CEO, Klaus van der Leest, has been really, really good. They put out a Q1 update that was reassuring. Contract wins are starting to come in through partner resellers. So I think that one's quite interesting, and the shares have done really well. Next day, I don't own this one. Purple Bricks, I think, is worth a fresh look. It's got pots of cash from selling off its overseas operations. Key point is it's changing its pricing policy now. So it's actually going to refund people if it doesn't sell their homes, which was the main flaw in the previous business model. It's UK focused now, tons of cash. I think that's quite interesting, worth a fresh look. Not one I own. I don't own TMO Stores either, but I just thought I've got to flag a few things that I don't own, otherwise it looks a bit much. Wednesday, last week was Somero Enterprises, which I think we're going to talk a bit more about later, so I won't cover that now. And Ready Northgate, both of those companies put out good results last week, so we'll cover those in a moment. Thursday, MPAC, I thought the results from that were good and it's reasonably priced, so that's worth a look. Inline update. Friday last week, yet another contract win from Cambridge Cognition, and these are quite sizable contract wins relative to its historic revenues. And finally, this morning, there were 3 that caught my eye. Science Group, SAG, that's been putting out a series of positive updates. It's still reasonably priced. Quiz, I like a lot. That's one of my larger holdings. Price to go bust, but actually it put out a pretty good trading update today. The balance sheet's strong. PhotoMe, I thought put out good results as well, mainly through cost cutting and restructuring. So that's it.
Great. Well done, Paul. Yeah, good run through there. And as you rightly said, we are going to cover a couple of those in the bash. So probably over to Kevin maybe for one of them.
Oh, really?
Well,
Good job we've arranged this well in advance. Which one?
Which one would you like to do, Kevin? You just do one, and Paul. I'm giving Paul a little rest. That's all.
Sure.
Well, I can have a sip of my rosé.
Yeah.
Well, I'm jealous actually, and I want to run to the kitchen and get myself a glass. But I guess let's look at Headlam.
Yeah.
So this is a UK group that sells various floor coverings such as carpets, vinyl, wood, and laminate. I am long myself, and haven't been for long. I bought it last year, sometime around about September time. If anybody wants to do a little bit of research, then they had a capital markets day very recently. And if you look on YouTube, you'll find on the PI World channel, this capital markets day video, which is, it's quite long. I think it covers, it's about an hour and a half. And they talk to this presentation that you'll find on the Headlam website. Again, I mean, this is 80 pages, but it gives you a quick insight into the sort of things that they're doing. So these are their various customer types that they have. So they're dealing with traditional retailers, sort of tradespeople, and then they're also selling to other larger retailers. They've gone through a large CapEx improvement plan recently. And so this impressive facility you see here is in Ipswich. And this is their Ipswich distribution centre, which is well, absolutely enormous. I think somewhere I've got some better pictures down here. The video doesn't play for me for some reason, but you can just see how massive it is inside. So this replaces numerous other facilities around the country, consolidates everything into one site, and adds material operational efficiencies for the group.
Did you say, where did you say that is, Kevin?
Ipswich.
I wonder why Ipswich. It seems way off the centre of the country, as it were.
Perhaps it's because it's near a port.
Yeah, because
it's near Felixstowe, I think.
That could
be.
A
lot of import goes straight to the warehouse. Yeah.
Historically, it's been a great little compounder. So put COVID to one side, it's done really well here. You can see all the way up to 2019, it's just eking out a little bit more every year. And you can see similarly coming through in the operating profit and the net profit. Big hit from COVID. But more recently, what they've said in their recent trading update is that essentially they are back to to be in line with where they were back in 2019. So we'll go through these numbers slowly. If you look at 2019, they were showing revenues then of 719 million. The forecasts for 2021 are only for 654 million of revenue, and for 2022, 675 million. Now, there's a small adjustment that you need to do because there's a little asterisk here. And if you follow that down to the bottom, this references that this is taking into account, excludes the contribution of the Swiss business that they sold in May of 2021. And that was about 31 million of revenues. But even then, if you take a look, if you can see, if you knock off 731 million of revenues from the 2019 comparator of 719, that gets you to closer to 688 million, which is still well in excess of the 654 million that's currently forecast here for 2021. So I think reading this recent trading update from the 1st of July, that actually they're signaling that they're going to be at least on a par with their 2019 numbers. And therefore, I think that these forecasts are out of date and that there are some upgrades that have got to come through. I mean, it's a nice little business. It's got a really good balance sheet as well. That they don't. It's net cash. No, it's not net cash. It's net debt. I think for about 8 million, perhaps. Yeah, here. So this was the more recent finals that were released on the 9th of March. And the average net debt for the year was 8.6 million. But yeah, okay. But they were net funds, so net cash of 51.6 million at the end of 2020. So this has always been run as a really conservative company. So on the one hand, look, it's not going to blow the lights out. It doesn't grow at massive phenomenal rates, but it does grow and it chunks out cash and it pays a decent dividend. So as I say, I'm already long, and I think this is a decent little business and one of the safer ones that you can put in your portfolio.
Great. And any thoughts on that one, Paul? Is it one you've covered?
Yes, that was very good. Kevin captured most of the key points there. The the freehold property on the balance sheet is, I think from memory, just over £100 million, which that's about a quarter of the market cap. So this thing's really solidly underpinned, and I think that could lead to it possibly coming to the attention of private equity. So I wouldn't be surprised if it was bid for, because what they often do is go for companies with hidden property assets and do a sale and lease back on them. That's one of the reasons private equity is circling the supermarket groups at the moment. So that's an important point. The Capital Markets Day, as Kevin flagged up, about 85 pages of slides on it, which I quickly whizzed through. It really highlighted all the things they're doing to improve the business and make it more efficient. They've already stripped out 7.5 million of overheads in efficiency savings, and it's great that they've come up with all these ideas for ways that they can improve sales, and they've streamlined the whole process of all these salesmen that were sort of competing with each other internally instead of having a single outward sort of look. And I couldn't help getting the impression from the Capital Markets Day that the whole thing sounded a bit of a shambles. I don't think they intended to get that across, but if it was making a sort of 7 or 8% operating margin with all these things wrong, then I look at that positively. The key point, as Kevin correctly identified, is that the broker forecasts are way too low. Now, if you strip out the 7.5 million of overhead savings that's already been done, I think earnings per share realistically is more likely to be between 40 and 50p a share, which is substantially above the current forecasts. And I actually managed to get hold of a note from one of the top brokers recently, which are like gold dust to actually get hold of them. And in that note, they pointed out how ridiculously low their own forecasts are, and said, you know, H1 has made our full year forecast look ludicrously low, or words to that effect. But we're going to leave it till September before we update the forecasts, because we want to see what the crucial summer season's like. And I mean, I think that's absolutely crazy, just leaving numbers out in the market that they know are almost certainly out by a really substantial factor. But therein lies the opportunity for those of us who read the trading updates and crunch the numbers ourselves. So I think if it's on a PE of 40 to 50, then, sorry, earnings per share of 40 to 50p, then your PE ratio is currently between 10 and 12. It's not 17.5. So I think 50p earnings per share is likely in due course. But I think a higher rating is justified. So PE of say 15. So I come to a target price of £7.50, and I don't think that's being aggressive at all in my assumptions. So that's 50% upside from the current price, with I think very little risk. And I think you'll also probably lock in some really good future dividends, again well ahead of forecast. In the past, it's paid out I think at least half of earnings as divvies. So buying at the current price, we could lock in a 5% yield. And again, you're protected from inflation because they just mark up the selling prices if the cost prices go up. Not going to strip the lights out, as Kevin says, blow the lights out, but I think it's just a nice thing to have in a sort of value portfolio.
Great. And an interesting link, one of the investors has just pointed out to me, Graham Waldron was the original founder of Headlam, and he was actually the chairman for a number of years at Tandem. So Tandem was conservatively run then, and clearly he ran a good business at Headlam. So it's an interesting little link there. Quite often these smaller companies grow.
Yeah, that reminds me. I think he set up it in competition with Headlam, him or someone similar, a former director. So there is that potential. There is that potential competitive threat. But Headlam has really unassailable buying power because it's the market leader in the UK, and it's got a lot of territory to go for that it hasn't really tried to address. That's what they were saying on the Capital Markets Day. There's loads of low-hanging fruit for them to go for, and I like the way they showcased other people within the business as well at the Capital Markets Day, not just the CEO and CFO. It's good when you see that other team members have got a lot of relevant experience in logistics, for example. So it feels like a business that's in a turnaround, I think.
Yeah. Well, it certainly won't have been Graham Waldron who set up anything, because he must be much older now. He was 70, I think, when I met him at a Tandem AGM. So I doubt he'll have set anything up. But
I think it's Tony Brewer. Tony Brewer was the former CEO.
Ah, there you go.
That's right. Yeah, you're right. Yeah.
In 1915, 1916, and he has set up this business here, which is Likewise Group PLC.
Ah,
And I've seen some comparisons recently between the two, but I mean, Likewise at the moment is very small, and I'm sure in time perhaps it could grow to be a competitor. But I mean, they certainly don't have the sort of buying power or facilities that Headlam do at the moment. They've been raising funds, so I've seen I think it was an open offer, because at this particular point in time, the shares for Likewise Group aren't listed.
yeah.
Interesting.
So there you have it. You get plenty of detailed information on this show. We've gone into competitors as well. Well done. And views overall then on this one? Buy, avoid, sell or hold?
Well, it's a hold for me because I've already got a position. Oh, sorry, this is you're asking the audience. Beg your pardon.
No. We are asking the audience, but wondering about your view.
Yeah, hold for me because I've already got a standard position size on it.
I could own more. I'd be happy owning more. So buy. Yeah.
Okay, great. Well, I shall read out, well, I'll close off the poll and I'll read out the result. I think everyone's just about voted now. Here we go. So we got buy 65%,
Wow.
avoid 5%, sell 1%, and hold 29%. So that's fairly conclusive there. Excellent. Okay, and next company, which will be you then, Paul. Which of the two would you like to do, Red A or Sun?
Well, I can do Red A briefly because I think you guys probably know Summerau just as well or better than me. So let me do this one then. So it's a $1 billion market cap. As you can see, a lovely chart over the last year. Looks very similar to most other things, to be fair. But it hasn't succumbed to profit taking in the last few weeks. I mean, that's been a very significant theme I've noticed over the last 3 or 4 weeks. I forgot to say that earlier. Lots of stocks have doubled or tripled in the last year, and a lot of them are now falling back on profit taking, which is understandable, I think. But Reddy hasn't. And the reason for that, I think, is it put out very good results last week. The forecasts, well, you can see there, the PE is only 11.5, the forward PE, and that's based on accurate broker forecasts. So I always check that, and the dividend yield of 4.3% is very good. Very high stock rank at 99, which is the Stockopedia proprietary system for anyone not aware of that scores companies from 0 to 100. Now also look at price to tangible book. That's a key measure I always look at. That's telling you the market value of the company as a multiple of its balance sheet net tangible asset value. So it can stripping out intangibles, and the lower the number, the better, basically. And 1.64 times is telling us that this thing's really, really strongly asset backed. So it basically owns an enormous fleet of vehicles, and then it's got debt financing against those. But the value of the fleet is I think, almost double the bank debt. So in other words, the balance sheet is really bulletproof here. And what they're looking to do is to rejig things so that in the future they're going to bulk lease the vehicles from the manufacturers and then release them to the end users individually or in small groups at a higher rate. And this is good business. This is the Northgate side of the business. So Reddy Northgate was two similar sized companies that combined. Reddy does the accident management stuff, providing courtesy cars for no fault drivers, but in cooperation with the insurance companies rather than in conflict with them, which means it gets paid quickly, cash generative. And then it merged with Northgate, which supplies white vans and makes good margins in the UK and Spain. Both businesses, all sorts of efficiency gains have been found by combining the business with the what do you call them, synergies have been as expected or better than expected when the two businesses are combined. And the most recent update and figures showed it beat forecasts, and that's when the Reddy side of the business is quite suppressed, because during the lockdown, obviously, People have not been using their vehicles as much. There haven't been as many accidents. So Reddy saw quite a big hit from lockdown, which will obviously come back. That business will come back now. The lockdowns have more or less ended. And the Northgate white van leasing side of the business is obviously going gangbusters because of all the e-commerce home deliveries and so on. Plus shortages of vehicles, improves margins. I just think it's a lovely business. I have no idea why the market only rates it on a PE of 11. And again, if you look at the Stockopedia broker consensus graph, the broker forecasts have gone up quite a lot recently. There you can see the most recent upgrades, which means that even though the shares have gone up a lot in price, the forward PE hasn't actually risen much at all. So I think this, personally, I'm just going to sit on this one. I can't see any reason to sell a company that's on a PE of 11 and trading well.
Great. Any thoughts for you, Kevin?
Well, once again, I am already long of this. And so I think it's a great little business. And in particular, it chunks out cash. So, I mean, you can see here, price to free cash flow of only 8. That's pretty good in my book. You can see EV to EBITDA, it's less than 5.5. I mean, that's a really low multiple. And yeah, there are synergies being identified from the merger of the two businesses. It looks great. And at the beginning of this year, if you'd have read the Stockopedia report, you know, they produced that report where they identified their top 20 for the year. This was number 18. And back then the share price was £2.70. So it's up over 50% since the beginning of the year. And look, it's phenomenally cheap. It's still a buy for me.
Yeah.
This one was actually flagged up to me by one of the readers, or two of the readers in the small cap value reports last October. And they nagged me and said, Paul, you've got to look at this one. You've got to look at this one. It's really cheap. And I remember writing a report on it in October. And I think it was on a P of 7, and it had just put out an in line with expectations trading update. And then the dividend yield was 7% as well. So how often do you find
a square share?
A square share, the same yield and the same PL. So I said to the readers, you know, thank you for flagging this to me. And obviously I bought some myself a few days later, and I've more than doubled my money on it. So a big thanks to the readers, and that I think shows what a great community we've got there as well, where it's a team sport. The readers flag up good stuff, and nag me to look at it, and it's great when they do.
And that's why we try and do it on Mello as well, of course, to try and make sure that all the audience get to see some of these companies.
I'm pretty sure. So again, going back to PI World, but I'm pretty sure it was this video back in December last year. Actually, I think it could have been an earlier one. So Tamsin did an interview with Richard Leonard, and Richard Leonard highlighted Reddy Northgate and gave a very articulate explanation of why it was phenomenally cheap and was going to turn out cash. I don't think that's the correct one, that particular one. I think there was an earlier one, but from perhaps July or August time. But browse through these and take a look.
You're absolutely right, Kevin. I remember that very well, and it was one of the things that piqued my interest. So many thanks to Richard. We've done well from his idea.
Great. So, current verdicts. Sounds like you both are buying.
Well, I've got loads of them already, so for me personally, it's just a hold.
Don't want to get too top heavy.
Yeah.
I'm probably more diversified than Paul. I could buy more.
Okay. Well, let's launch the poll and see what the audience think. I must admit I hold Reddy as well. In fact, Leon and I went to see them about 4 or 5 years ago, the management, way before they acquired Northgate. And I loved it then because the dividend yield was very high then. I think it was about 8%. So.
I should point out, Reddy did have a setback a few years ago when they had one big insurance client that cancelled the contract, and that did, I think from memory, roughly half the share price. So it took a while for
Yeah.
it to recover. So, I mean, it's more diversified now. It's Ready Northgate.
Yeah.
But there is a risk there with client concentration that we should flag up just to be completely even-handed.
Yeah. Great. Have we got the poll then for the audience? Let's have a look. Maybe not. Oh, there we go. There we go. Fire away, everyone. We still got nearly 300 people on the show, so
Right.
we're keeping them up for a better night than last night, maybe.
Well, let's not talk about that.
No, let's not mention that. Don't mention that. Okay. Right, well, let's share the results. Okay, for Red A, we've got buy 58%, avoid 4%, sell 4%, and hold 34%. So a little bit similar to our last one, really, but sounds like we picked one that most are keen to buy or hold.
I wonder why 4% said avoid.
I
Just
know.
curious. Yeah.
We'll have to get them to type it into the Q&A box. And
Yeah,
let us
maybe they
know.
don't like the sector or something.
Yeah, true. True. Okay, and the final one is Somero. Do you want to mention?
Do you want to go on it,
through
David?
that one?
You know this one.
Well,
don't you,
I have known this one. In fact, I found it at an AGM, bizarrely. Somebody told me that I should go and meet the management because they come over from America. And it's a concrete leveling equipment that they have, laser guided, and various ways in which, you know, construction buildings are built needing good flooring, and concrete is one of those things that you need to be level or else the whole thing gets out of kilter. They tend to do very well when, you know, the general construction industry is buoyant and things are getting built. And of course, at the moment, coming out of the pandemic, there is a lot of infrastructure projects to keep the countries ticking over. And at the moment, they're showing very healthy returns. I think their last update said they were in a good place. I don't know if you can bring up the last update, Kevin. That's there we go. Raising guidance due to stronger than anticipated trading in the US to end H1. So this is one that, you know, you can tell that going forwards, things are still very buoyant. The only time generally that you have to worry with Somero is when the industry sort of tightens up, and of course they won't get the need for their equipment to be used all around the world. In fact, not just America, they're all around the world. They do usually give a breakdown of all the different geographic parts around the world. And, you know, they pay a lovely dividend, although it has withholding tax. I think you'll correct me if I'm wrong there, Kevin. It's one of those that you have to worry a little bit about the dividend and how you've got it paid.
Stick it in your SIP and there's zero withholding tax. But otherwise, yes, there's withholding tax.
You've got to fill in a form to.
It's American.
Yeah. But yeah, it's been a high yielding company, doing very well. I love the management. They always tell it how it is. You know, and until recently, they always came over to the UK and told us how it is. And we're happy to meet investors. I know there are quite a few that have been in it over the years as well. I don't know what you two think about it, but it's certainly still in good shape.
You want to go next, Kevin?
I bought this last year. I think there was a particular point in time when you mentioned in a WhatsApp message that it was a buy, Paul, and I bought it. And for some reason, I didn't hold it for very long. I held it for about 6 months, and I got a feeling when it flattened out at about 360, around about there, I sold it. And as I was looking at the numbers today, I was sort of thinking, why on earth did I sell it? Because, again,
well, it's probably because I think the company had given a series of positive trading updates, but then near the end of 2020 or early 2021, I think they said the next year is going to be a year of consolidation. We're going to increase sales and marketing, and there'll be a delayed payback on that. So I think a lot of people kind of got bored and said, oh, I'll sell on and come back to it a few. But in the meantime, we've had 2 or 3 positive updates this year. And the most recent one, they upgraded the forecasts by 13 or 14%. So
Yeah,
I think you can forgive yourself for being caught out by that, I think, because it was unexpected.
So, I mean, in terms of growth, they dropped a little in 2019 and in 2020, but then the forecasts for 2021 have just boomed. So there's a huge jump, which has been forecast in the latest trading update, which was from only last week. So yeah, going to 110 million, which is a big shift compared to 88.6 that they are. And look, it's back firmly on a growth trajectory. I mean, looking back, you can see, just looking back to where it was, a decade ago, that all of this share price increase is justified by increases in revenue and underlying growth. So it's skipped some growth for a couple of years, but otherwise it's back on track.
And look at the forward PE as well, based on forecasts that, as we know, it's tending to beat. Only 13.9. But look below it, the quality scores. You've got a staggeringly high quality scores and a PE of only 13.9. I don't think I've seen that. I don't think there's any other company on the market where you could get that mix.
The thing I'd like to do is to open up this page here and compare it with all the others.
Good idea, yeah.
And lo and behold, yes, it is. It's number 1 in its sector compared to everything else. So that's rated by stock rank. But you can fiddle around and slice it and dice it compared to others. Rating comparisons by stock rank are normally a decent indicator that it's the best in the sector.
Yeah.
So,
I mean, a couple of other points.
Companies here, you've got to ask yourself, why do I own that company instead of owning Samara?
Yeah. Just a couple of things to add as well. Part of the growth, the growth is mainly coming from a very strong US market. I mean, you do sometimes wonder, I do sometimes wonder why it bothers with overseas markets, because nearly all the revenue and profit comes from America. These e-commerce warehouses are proliferating now, and of course they have quite high stacking shelving where even slight imperfections in the concrete flooring can make the racking unstable and dangerous and so on. So the more e-commerce warehouses are built, the more Somero's equipment is used by the flooring contractors. And I've always wondered why it was that they don't seem to really have any credible competition. And it's fundamentally down to the nature of concrete, that if you buy a sort of reverse engineered machine from someone else, and something goes wrong, you've got about half an hour to an hour to fix the problem and clean the machine, or the concrete sets. And at that point, the machine's wrecked. So it's actually, this is what the company tell us, it's the customer service that is multilingual and that they can fix problems fast with a helpline that gives them their competitive advantage, apparently. Which I thought was quite interesting. And new products, they've launched and are launching several new products as well for different applications, like high-rise blocks and so on, that apparently are also receiving good uptake from customers. Bare points, the only ones I can think of, people always say, well, why is it listed on AIM, a predominantly American company? And you have got that disadvantage that some people can't get the withholding tax, although I've never had any problems. You just fill in a form and it seems to come through fine. But the company's been listed on AIM now for many years, and management, whenever they're asked this, say, we're perfectly happy with being listed on AIM. It works great for us. Maybe it's not big enough for the US stock market. I don't know. It's very cyclical as well. Obviously, it crashed in 2008 and almost went bust when the withdrawal of credit was widespread. The customers couldn't buy the products. But it was in much worse shape financially back then. Since then, management have built up the balance sheet and keep a big buffer of net cash. And then anything above that figure, they pay it out as special dividends. So you could get more than 4 or 5% yield because you get these specials every now and again. Very, very good management. We've met them a few times, haven't we? And they're just completely straightforward, very open. I think there's an opportunity for a re-rating with this stock. I really don't understand why it's on a PE of less than 20 in the current market. 20 is not an expensive rating. There are lots of inferior companies on much higher ratings, and I think it might even be a takeover target. So yeah, and we've loved this share for years. I mean, the small cap value reports, we've been going on and on and on about this for years, about what good value it is. So it's nice when they finally come good.
Yeah. Great. Well, yet another good company to alert the investors to. So let's see, what would you say current situation, valuation? How would you be a buy, avoid, sell or hold, Paul? Obviously a buy.
Yeah, I should probably buy a few more. I haven't got a particularly big position in it. So yeah, I'll go for a buy on this.
Kevin?
Absolutely, it's a buy. It's a good, solid company. It's got a very solid balance sheet. Well-run business, it just oozes cash.
Yeah,
it's a great business to own.
Yeah, I've held it for years, and they've always said to me that any excess cash will be paid out in dividends. So it's a nice one to hold, really. Anyway, the audience have now started to vote on it, and let's see if that's ready. Great. Okay, so the audience say buy 55%, avoid 3%, sell 3%, hold 40%. So a little bit more balanced on the hold or buy. But looks like we've come up with 3 good companies there, and well done, both of you. Thank you.
Thanks. I think they all fit a nice theme as well. They're all very similar. You know, companies that are performing well, great balance sheets, paying good dividends, and a cheap on a PE
and good recent updates, really.
Good recent updates, yeah. I never buy anything unless there's been a recent positive update, because you want to take as much guesswork out of it as possible. Oh, and I should mention, Justin has just flagged. He says in the audience, he says, I went for a void on, this was Ready, I think, wasn't it?
Oh, good, yeah.
Due to the high net debt, which is quite an interesting comment. Although, as I say, I think if you see the debt in the context of it's only about half the value of the vehicles they own, it's not really high at all.
I looked at the debt. So the debt comes in at 1.75 times EBITDA. So net debt to EBITDA, which is the traditional way that you look at these things, and certainly the way that the banks look at these things, is 1.75 times net debt to EBITDA. And their target is to be in the range of between 1 to 2, which would be a traditional target for a listed company in the UK. Certainly elsewhere in the world, in the US, for example, you'd have much higher multiples. I think, I mean, they paid down a lot of debt last year just because it's chunking out cash. And you know, it's certainly, it's a big number, but it shouldn't be a number that concerns anybody really.
No, I mean, it's asset funding debt. That's the key thing to stress. It's not structural debt for working capital, is it? You know, it's literally they own $1 billion or whatever of cars, and they borrowed half the money to finance this fleet of cars. So
the thing I really liked when I was looking at their cash flow statement as well is that within the cash flow statement, they had already allowed for the replacement capex of replacing the fleet. And so they quoted a free cash flow figure. I think they had an unusual metric that they called it, but it's cash flow something or other. It was about 140 million, which was just, I mean, yeah, it's a lot of cash for a business that size. Yeah.
I do like this session, guys. Justin's just replied again. He said, thanks for taking the time to answer. Very good reasoning.
Oh, that's nice. Thanks, Justin.
Yeah, thank you. And just to mention another one on Ready, Richard has said, he said avoid as their recent profits will have been inflated by very strong residuals in the used van market.
Yeah,
and
good
now
point.
they are leasing, they won't benefit from the inflated residual.
Yeah, fair point.
That sounds plausible.
Yeah,
I think that I'm working on the basis that is a very valid point, but it might be offset by the recovery in the ready side of the business that was badly suppressed in lockdown, and that's now recovering. So I'm kind of thinking they'll offset, but I don't know that for sure.
And on Samero, Ian says the top management are aging. Are there any succession plans that you know?
I don't know.
Probably not that we're aware of course. That's a board issue.
Not that I'm aware of personally. I am available though, if anybody. The non-executive chairman is 85, so that's the CEO is 73. Okay, we're getting down to younger when we get to the CFO. Yeah, okay, it's a good point, but it's an American business, and they like their senior figures in the US. Just look at their president.
Another one on Headlam this time. Bill Hall, who I know follows lots of these companies, he says, how does Headlam stack up against James Halstead? Do they serve the same markets, and how do the ratings compare? Probably one for Kevin then.
Well, we can
bring them up.
We can bring them up.
Well, what was it on Halstead? Whenever I've looked at it, I just cannot understand why it's on such a high PE rating.
Very high.
Massively high. And a lot of people say, oh, it's a wonderful business, blah, blah, blah. I'm sure it is, but maybe it's buying from inheritance tax funds, possibly, that tend to bid up the price of a lot of AIM stock.
Kevin's added Victoria Carpets as well.
I had to put it in. I mean, I'll leave it in if you want me to.
Yeah, why
Victoria's
not? Why
an
not?
interesting
We should.
one.
Yeah.
But well, look, I mean, sorry, did you say? I didn't catch the name of the who raised the point, but on the face of it, James Halstead is beating it according to Stockopedia's system.
What about the valuation, the PEs though?
Yeah.
Yeah, you see there, you've got a PE 29 on James Halstead and 17.5. Well, we know Headlam isn't 17.5; it's nearer 12 if the forecasts were corrected. So, but I don't know whether the Halstead forecasts are accurate or not.
So it's very difficult to work out
what it's a winner on.
What's going on in the black box behind this, but
I think you've got to bear in mind that a very, very unusual circumstances like we've had in the last year or two, when broker forecasts are so wildly out that a data-driven approach can lead you up the garden path if you're not careful.
Yeah.
Because the forecasts are so wildly wrong for some companies. Some they're too high, some they're too low.
Yeah.
You can't be, double checking everything manually, I would say.
Yeah.
Yeah, you can sort of see how there are more green boxes on the right-hand side for James Halstead versus Headlam. So, okay, it's a good point. Yeah, I didn't look at other comparisons against Headlam. And it's a simple enough thing to do. So you go into Headlam, you go up to the top of the page, household goods, and you just open that, and that'll show you all of its competitors.
Yeah, so there's Sanderson. That's a lovely company.
Yeah.
And Port Merion I like as well, and UPGS. That's a nice one that we touched on earlier.
Yeah. So I am long of Port Merion, and I remember mentioning Colfax last time.
Yeah, you did.
Sanderson Group, and somebody told me afterwards, "Shh, don't talk about Colfax. I'm trying to buy a position in it."
Well, it looks like they did. The chart's gone up.
Yeah,
quite small,
this
isn't it?
is just
46
an investment theme at this particular point in time, that if you're going to get into the DIY space or just home decorating, or also getting into cars, this is where consumers are directing their money because they're not going on holidays.
Yeah.
But is that going to be a permanent trend, or is it transitory just for last year and this year? I suspect more the latter. So there may be some rotation out of these things.
Doesn't mean you can't invest for a year or 2 years. Great. Oh, well, I think that just about wraps us up nicely. There's no more questions in the Q&A box or comments. So thank you, both of you, yes, again, on every exit survey. And don't forget, guys, there's one at the end of this Mello. So do give us your comments, because we like to know what you enjoy. But every single one, Paul and Kevin are always in demand. They say,
that's nice to
get them
well,
back.
It was meant to be Jack. It was meant to be Jack Brumby doing tonight, but he's moving house. So
Yes.
I'm his stand-in tonight.
Oh, you're a good stand-in, Paul.
Thank you.
And everybody likes to see Maggie, and now we got the Queen as well. That's very
well, you know, got to be done.
Yeah, great. Well, thank you, Kevin. I know you've had a busy few weeks, but good to have you back. And hopefully it's been a good Mello for everyone. Hope you've enjoyed it. You haven't got, I know you've had 3 weeks to wait for this one, but you haven't got long for the next one. We're back next week, and we've got a great show lined up. So they come thick and fast. Do complete the exit survey. Do, if you can, let us know your thoughts on going physical. We're planning an event in November. We need to know you're going to join us, or else it won't be worth planning it. But certainly we want to add physical to our virtual world. I think we've hopefully given you what you want in the virtual world, and we'd like to get back to a bit of physical. There are at least a few hundred who like to network and meet. So let us know your views. Good to see you all tonight. Hope you have a great week. And thank you both. You might even be with us again next week, or at least one of you will be, I think. Thank you very much. Good night, everyone.
Good night.
Thanks, David. Thanks, everyone. Bye.
Thank you.
Bye.